Hit it.
It's Friday, January the 13th. Friday the 13th, Kev, of 2023, episode 204. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the great pleasure of welcoming Paul Podolsky, Wall Street and hedge fund veteran, who has recently written a book called Master Minion. We chat about his career, his experiences on Wall Street, and how a conversation with Paul Volcker inspired his latest book. Then Patrick answers the question we have all wanted to know in Talking Charts: which of his crayons tastes best?
We then do the new segment. We give it a go here, Kev. That crazy idea you have. We'll see how it goes the second week in a row. We then end with our no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on here. What beer are we drinking this week?
So this week we're drinking, or Patrick's drinking, Lady Friend IPA by Laura Brewing Company.
We were actually trying to find it, and something's happened in the Muir household. I do have a teenager or two, so I'm thinking
we were working so hard to coordinate the same beers, and then
so we got the same beer, and we did all this thing. It came from Portugal or whatever, and then it ends up being that it gets drunk by one of the.
This is not from Portugal. This is from Toronto.
Oh, this is a Toronto one. Lena, tell us about the beer.
So this beer-punching, thirst-quenching, juicy IPA has a firm bitterness and big body. It has bold notes of sweet papaya, ripe melon, and young spruce tips, balanced with a round, malty character and firm bitterness. This IPA is not for the faint of heart.
Well, Patrick, sounds like it's right up your alley.
Oh, no, it's actually a pretty solid IPA. We'll rate it later in the show. But
Well, I'll tell the side effects in 1 second, but I will say the fact that you knew it was Canadian when they described it using an evergreen tree. It's always in the Canadian IPA. It's a spruce or a pine, maybe a tamarack, but it always tastes like
it's always in there.
It's always in there. All right, listen up. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include the Bahama bank runs, the Tesla testicular-ectomy, and the gold bug glaucoma.
Oh, I suffer from all three. This is horrible.
All right, on to our interview with Paul. It's our great pleasure to welcome to the show Paul Podolsky. Paul is a writer and an investor with an unbelievable pedigree, and it's a real pleasure to have him on the show.
Thanks so much for having me.
I've been looking forward to this for a while. One of our previous guests, reached out and said that you would be a terrific person to have on. And when I had a look at your resume, I went and looked at it through, and I said, of course, he'd be a terrific guest to have on. And I said, we got to get this Paul fellow on. So why don't we just start with a little bit about kind of your background, how you got into, you worked for a bunch of different firms that were kind of storied firms, Bridgewater and Wall Street. And I believe you were also a reporter. Why don't you tell us a little bit about your life? First of all, where did you grow up?
Yep. I grew up in Washington, D.C. My father was a scientist who had actually started out early in his career working on the Manhattan Project. And growing up in D.C., there are a ton of foreign embassies. And I was always very curious about where the heck all these people came from and how they fit together. So I was trying to understand the world. And my first effort at trying to make sense of that was studying history in college. And I didn't feel like that actually answered things well. And immediately after college, I graduated the same year that the Soviet Union collapsed.
Okay.
And I got an opportunity to move to Russia and work as a reporter. And I figured, listen, I don't know if this is going to answer this question of how it all fits together, but at least I'll come out of it with a better ability to write, and I'll learn a foreign language.
Well, that's fascinating. So how did you get that job? Like, because you didn't go to journalism school, and yet here they are, you're picking up a job as a journalist in an exciting time and kind of in a monumental place.
Right. So one of the things I think that you were looking for sort of both insight for people who try to get into the industry is just how much I think luck and happenstance really matters in our life. So I graduated college in 1991. I went to Brown. And if you remember then, that was a period of time we were coming out of a period of tight money. Unemployment was high, and it was difficult to get a job here. And my key criteria for getting out of college and getting a job was not necessarily that I was going to earn money. I wanted to do something that was really interesting.
Okay.
And somebody offered me a job there initially to teach in a school in downtown Moscow, Moscow School 345, which is a special school for mathematics. Kids are unbelievably bright. And I took it, thinking that at least I would learn these concrete things. And then once I was there, I started writing and I started selling stories. And that's how I got my start in journalism.
Wow. Okay, so what was that like, Russia in 91?
It was mind-bending. I actually learned more living in Russia, I think, that I learned in college or graduate school. And it took a long time for it to sink in. And the basic issue is the world that I grew up in. Yes, there's lots of problems in DC and in America in the 70s and 80s, and there still are now. But the basic feature of the world we're in now is modern. And by modern, I mean that it is run by rule of law and technology changes how things work. And traditional holds, like what the village elder says, don't have that much influence on our day-to-day. And the economy now is radically different than the one that I grew up with, and probably you grew up with in the 70s and 80s. Russia wasn't like that. It has features of modernity. It has rockets, it has a space station, but the essential structure to Russia is medieval. And by medieval, I mean that there is a king, and if you misbehave, you will be poisoned. And if they don't like what you're doing, they'll seize your land. That's essentially medieval structure, like what you'd see in medieval Europe. And it's so different than what I grew up with that it took a long time for it to sink in what that reality was like. And then once it did, and it took a couple of years of getting through the language, etc., it radically changed the way I viewed the world in two respects. First of all, it gave me much more appreciation about how to filter perspectives, almost like if you're an optometrist and they're checking the lenses to see which way the letters look on the screen. Being able to do that from a Russia perspective, from a Latin American perspective, from a Chinese perspective. That was one thing. And the second thing is I understood that while history was really useful for understanding reality, prices actually were a much more powerful prism. The reason why the Soviet Union collapsed, essentially, was because they had the wrong price on things. It was
How did you come to that conclusion?
By watching, because you'd see so much stuff that was so crazy there that you would struggle to make sense of it. So, for instance, the time I was there, and it's still true today, Russia was unbelievably corrupt. And I was like, why is this place so corrupt? Well, some of it has to do with a very ossified ruling structure. You pay tithes in a traditional society, and you do there as well. But the other thing is that the prices were just all wrong. In other words, if you don't have the right price on toilet paper, you could have the biggest forests in the world, and there will not be toilet paper in major cities, which is what the reality was. A heart surgeon, no matter what system of government you have, earns a certain price. If you need heart surgery, you're willing to pay. Now, if you pay a heart surgeon less than a coal miner, corruption will develop in a nanosecond. It's impossible. And so I began to see that if you wanted to explain things, it wasn't like by reading Tolstoy or Dostoevsky or understanding Tsarist history that you could understand this corruption. You had to look at it through the prism of prices. And that's when it dawned on me that this, which many of your listeners maybe realized much earlier than me, but I was just trying to understand what was in front of me. If you understood how prices were formed and how they interrelated, you would have way more explanatory power of what was going around you than if you didn't. And that's when that whole exploration really deepened for me.
That's fascinating, because I'd heard the story about during communism that the Russians would have trouble setting prices, obviously, because they were, it was done by a bureaucrat somewhere. And they would actually get out the Sears
downtown Moscow. They actually planned. It would be like people, you and I, sitting down with an unbelievably complicated array of deck and being like,
right, and they would try to allocate resources based upon this. And then they did such a bad job of it that I heard they started using the Sears Roebuck catalog to set prices.
Oh, I haven't heard that story. That's a great story. But there was a lot of things like that. The other thing is that there were actual coups while I was there. So I came shortly after the first coup, and I was right in the middle of the second one in October of 93. And of course, if you read history here, you know, okay, there was a revolution in the 19th century, and you can go to Boston to see the sights. But I'd never seen anything like that firsthand. When people disagreed with each other, if there was no structure for conflict resolution, violence was the next resort. And when you saw tanks in downtown Moscow firing, live fire, and you could stand relatively close to them, that also radically shifted your perspective about all these structures that sort of operate almost effortlessly in the United States.
You mentioned violence. As a reporter, did you have any threats to your life in terms of what you'd write about? And did you find yourself kind of constrained in terms of what you could write?
Yes. So you had to be mindful of that there. And in the time I was there, you know, tragically, somebody who I studied with was killed. Somebody else I knew socially was shot and survived. And then right after I left, a Russian journalist who I worked with, was murdered by the government by poison. That was just when that was beginning. So violence is all around. One time I was speaking with a guy, an aluminum smuggler, and he was describing to me his business. And I was, you know, we were introduced through friends. We were at a table and having a conversation. And I said to him, "Oh man, this is great. You know, he's explaining to me the trucks and how he pays off people, and what the profit margins are." And I said, "Listen, would you mind if, like, anonymously I do a story about this? Because this is really going to explain what's going on." And he said, "You're free to do a story." And he said, "You just should be aware of the risks." And I said, "Well, what risks?" And he goes, "If there's anything in your story that can in any way be traced to the actual trucks that we're using and what we're doing, you will die. So you could do the story, just that's so, you know, it's judge, risk, reward." And I said, "Okay, I'll pass on that one. I'll use it." And then some of that material, and we're going to talk about it later, showed up much later in the book that I recently wrote.
Was that ultimately why you decided to leave Russia? And what was the next stage of your career?
I got married there and had a child there. And so I went from being a single guy. And by the way, when I went over there, everybody told me, you know, be very cautious about getting into a relationship with a Russian woman because the divorce rates are high. We just celebrated our 29th anniversary. So that was a little bit of an out of consensus pick. And I came back here, got a graduate degree in economics, and then worked as a reporter in New York for a couple of years, really at the the lowest rung on Wall Street, which was reporting for stuff that nobody reads deep inside the C section of the Wall Street Journal on, like, the cotton pit, copper, gold, and currency. And that's where I got my start with really dealing with traders day to day, first on the outside as an observer.
That's fascinating. So you're working for the Wall Street Journal, and you've gotten your graduate degree. Where did you go to school for your graduate degree?
I went to the Fletcher School of Law and Diplomacy, which is part of Tufts.
And in terms of your reporting, you're not really using your graduate degree very much. Was that ultimately why you said, I got to do something else?
Well, I was using, technically I was working for, my employer was Dow Jones, and my reporting showed up on the wires and also in the Wall Street Journal. It was a couple different things. One of them was when I was talking to sources, my starting salary at Dow Jones was $38,000. And I was supporting a family of 3 in New York. And that was more money than I made in Russia, but it was not a lot of money. And my wife, bless her soul, being somebody who had been born in Siberia, was like, "Buck up, we'll deal with it." And I was like, there's got to be a better way, because my living standards have actually gone down from what I lived, you know. And so
Kids don't do that to you.
Yes. So I was talking to my sources. At that point, I was covering foreign exchange. And I started it dawned on me that the people who were the currency analysts, I didn't feel like had any particular insight that I didn't have. And they were making 4x what I was making, or 5x or more. And so I got a break. This also mattered. One of my sources was looking for an analyst and asked me to join him at what was then Bank Boston. And I ran it by my wife, and she said, I was like, "Well, we could go to Russia and be foreign correspondents, or I could become like a banker." And she was like, Are you crazy? Become a banker. So that, and this is another place where luck really mattered. So I was interviewing for that job in August of 98. Probably you remember very well. It's the epicenter of the Asian financial crisis. It's receded into the past now, but at the time, really, people thought the world was going to end. I think I failed just about every interview I had on the desk that day in August of 98. But what was going on right then was around Russia. Would they default or not?
Oh, yeah.
And because I had spent these years in Russia, I knew every single person who was involved in this. Who the prime minister was, what the relationship was, the Ministry of Finance, who was running the central bank, what the blah, 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 blah. So when the chief of the area there interviewed me, I could tell him in just through luck. Like if the crisis had been any other place in the world, if it had happened, it was just earlier when it was happening in Thailand or whatever, I would have been done.
Right.
But in this specific area, I could answer with clarity. And on that, he said, "Oh, I'll make a great analyst." And so in I came.
That's great. I always joke and say some people are lucky enough to be born smart, and then some people are smart enough to be born lucky. You sound like you're both. So you're there, Bank of Boston. This is New York?
Boston.
Oh, it is Boston.
Boston.
You had to go to Boston.
Square.
So you had to pick the family up and move to Boston. But how
Exactly.
was that, by the way? So now you've done Washington, New York, and Boston.
It was fantastic.
Yeah,
we were living in such limited circumstances in Brooklyn that moving up to Boston felt like a huge promotion. And it was great. We lived in there's lots of nice places to live around Boston. We lived in Brookline. I could close to work. And I started off there analyzing currency initially, being what was called a currency strategist. So there was the traders, there was the salespeople, then I was part of an analytical team that was supposed to give advice to people about what was coming up in terms of foreign exchange risk.
Okay. And do you do that for how long? And kind of
6 years and 2 mergers. So we got bought we merged with Fleet, and then Bank of America bought us. So I was there for that period of time. And the compliance rules at that time were not what they are now. And you could open, was totally on boards to have a futures account while you were offering this. It was actually encouraged.
Of course, they want you to trade. They want you to feel the kind of, if you have a view, you should have a position.
Correct. And so I still have my first trading confirmation on my wall just to my left from a defunct, and this actually relates to all the stuff with FTX and all these things, a defunct futures brokers, Lind Waldo.
Oh, I remember them. I traded with them.
My first trade was in Canadian dollars.
Oh, there you go. What did you do?
I bought, and I remember at the time I had about maybe $3,000 in savings. And as you know, a single Canadian dollar contract is $100,000.
Right.
So putting on that almost gave me a heart attack. One of my friends said it was on the road to ruin, but I learned something very important, which was that there was a big difference between having a view intellectually, like this is, doing all the analysis about real interest rates and discounting, current account, and all this type of stuff, and wearing the risk.
Yeah.
And so from there, I started to trade currency, and then it just grew from there, from trading currency to then bond futures to then equity futures and then individual commodities, et cetera. And so I just started to build out, if you will, a picture of the world asset class by asset class and tried to figure out how they interrelated. And of course, we were selling protection to people. But in that process, I got very interested in how people assembled portfolios. And that's what I was trying to figure out and reading everything I could to try to make sense of that.
It reminds me of the line that Yogi Berra says, in theory, there's no difference between theory and practice, but in practice there is.
Yes, huge. Yes, and I remember, things, the dealing with the stress was a huge part. Like, how do you keep a clear head when you have risk on? And I remember key calls that I had to make for the bank in terms of what was going to happen with monetary policy, where my view would disagree with the bank economist, or where I was actually trading my own money and learning how to what was appropriate risk and how to think about that and what was normal deviation and how things interrelated. It was a lot of hard lessons and a lot of mistakes.
So you started off as a reporter, you go on to
Yep.
the sell side, and then your
Yep.
next journey is to the buy side. Can you tell us a little bit about that?
Correct. I really wanted to get to the buy side. And it was hastened by the fact that when Bank of America bought us, they did what they typically do, which is they keep the customers and fire everybody they can. And I was among the people who got fired. So I had a young family then, mortgage, and I'd been at this 6 years. And I was crystal clear that I wanted to be on the buy side if I could. And I was really interested, given my background in macro investing, and so there weren't that many really notable macro investors at the time. There was Soros, who I'd met a couple of times and was unbelievably impressed by. There was Caxton, there was More Capital, there was Tudor.
Actually, before you go on, the fact that you
Yes.
said that about Soros, what impressed you so much about him?
He has, so this is another funny story. So Bank Boston had a membership to the Council of Foreign Relations. And it was for the CEO of Boston to attend these, very important G7 IMF meetings. And in the room would be, Larry Summers, the heads of all the major banks, the major hedge funds, including Soros.
Okay.
And they were like, I think the guy's name was Chad Gifford, who was the CEO of Bank Boston. They're like, Chad, do you want this? And he was like, no. And it sort of went down. Then it went down to Enrique Morales, who ended up being central bank governor of Brazil. Do you want to go to these meetings? No. And they kept going down and down and down. And finally it got into the foreign exchange. It was like, listen, we have this open invite. Does anybody want this? And I was like, are you kidding? Yes. So I was going to these things and trading a contract or two of Canadian dollar. And
Who
I'm
is
in the
that
room
odd
with-
lotter that's over there representing?
Exactly. So what blew me away with Soros is that I only had a few conversations with him, but he was unbelievably good at synthesizing unbelievably complicated arrangements of variables and offsets in a single sentence or two. He was the first person who really had fantastic synthesis when I describe it. And it's interesting because I've read his books. I don't think his books are very good. I think he's a genius, but it's like The Alchemy of Finance I read, and I finally got what he was talking about, but it's terrible.
Yeah, it's a little all over the place.
Yes. Yeah. And it's like it's a classic thing that would make a great essay if he had an editor who would crush him a little bit and force him to do. But it verbally wasn't like that. And I'll give you a single example, which was in December 31st of 1999, Putin is relatively unknown and he gets appointed head of Russia. I happened to be at one of these events with, and Soros was there at a very small gathering. And I walked up to him and I said, Mr. Soros, what do you make of the recent appointment of Putin? And most of the time, if you go back and look at the time, nobody was saying that this guy was what I've described in my Substack pieces as Voldemort. Nobody was saying that about
Most
him.
people didn't know who he was even.
Correct. Yeah. And Soros just looked at me and he looked straight at me and he said, not to be trusted.
Right.
He was the first person that said that of anything. And he was years ahead of other people. And there were examples through the Asian financial crisis, which I didn't write down, unfortunately, but it is a similar type of thing where you'd see people struggling to make sense of things in one or two sentences, and he could nail it verbally. Writing, not so much.
That's a great little tidbit. I'm sorry to interrupt your story. I had to know when you said that he was that good. I had to know why he was so good. Okay, so you're sitting there, you're at Bank of America, and you're looking around, and you're going through all the different people that trade foreign exchange. Yes. There's all these macro type hedge fund guys, but you end up
no one's hiring. No one's hiring.
Okay.
And true story, and some of the people who I did interview, I was willing. Buy side was the first choice, but I need to be practical for my family. I was interviewed by Bear Stearns. They said that I didn't have the conceptual ability or something like that to do the job. at the same time that I was hired by Ray Dalio. So, like, these moments matter.
Well,
So
I just laugh. Sorry to interrupt. I just laugh about that because, like, how many times in history have you seen like the rejection letter, the U2 or the Beatles?
Yes.
All these people that got passed. So I always, whenever someone gets a rejection letter, I always say, don't take it too seriously. It's just meant it wasn't a fit for you at that spot time.
Be resilient. Yep. So somebody introduced me to a headhunter who was hiring for Ray. And I met her, and then she said, "Oh, I think you'd be a good match." And then I went down there and drove from Boston to Westport, Connecticut, where their offices at the time were off in the woods.
Yeah, with a beautiful picture, like it's kind of up on stilts or something, right? And there's beautiful.
Well, it's built right on the water. Right. It probably wouldn't get approved now, basically near the Saugatuck River, and Ray, at the time, the Bridgewater I think there was about 140 employees. And Ray at the time did all of the interviews first. He was the first person to interview everybody. Really? Because I think they had too many interviews where somebody would pass these different stages and then Ray would interview them and say, no way. And they were like, okay, this is a waste of time. Why don't we just flip it and let Ray be the first interviewer? And if he passes Ray, or she passes Ray, then they'll go on to the other people.
Now, at the time, though, Bridgewater wasn't the behemoth it is today.
No, it was very small. And Ray was known as a person. I asked my friends on Wall Street, I said, what do you think this guy, Ray Dalio? And they said, quirky, does really good bond research. That was all the reputation was. At that point, Ray was in his mid-50s, which is where I am now.
Right. I remember those Bridgewater Daily Observations or whatever it was. That somehow they would kind of get passed around. I remember reading it and just thinking this was the greatest stuff ever. Yeah. Not a lot of people were doing it back then.
Great research. And the business then was more bond management, currency overlay, these types of things, not as sexy as like the biggest macro hedge fund in the world at the time.
Okay, so you get interviewed by Ray. You guys hit it off right off the bat?
We had a pretty good conversation. So Ray came in and the interview was unlike anything else I'd had with anybody else, which was he wanted to know about growing up.
Oh.
Who was mom? Who was dad? What did you talk about at the dinner table? And it went from there, and it sort of expanded, and I can't share a lot of stories from Bridgewater, but I can share this one, which was in the interview, he asked me about those things at home, and I said, well, I had an older brother. I said, we're pretty different. I said, I remember being in traffic. I said, my older brother had a little bit of a temper. And if we'd be in traffic, he'd start banging on the steering wheel of our Dodge Dart and using profanities. And I said, I was always a little bit more of a dreamy kid. And I saw Ray pause for a little bit. And I said, I was always wondering what caused the traffic jam to begin with. And Ray's eyes just lit up. It was like we were kindred souls. And he and I, for over time, and then he asked me about my market views, and I was just very honest with him. When we were talking about currency, I had solid views. We were talking about bonds, okay. And then when we got out from there, he continued asking questions to see. He said, what are your views on equities? And at the time, I said, you can ask me my views on equities. I said, but I'm really just beginning my study, and I think my understanding is probably going to be relatively primitive to what you have here. So I'll give you my answer, but I want to. So we had a conversation, and it went, it seemed to go okay. And then in the middle of that interview, after him came a bunch of other people. They came into the person sort of managing the interview and said, listen, we want to have you talk to a few more people, but we're actually pausing everything to have a swim race. And I was like, what?
A swim race?
They said, yeah, we're having a swim race starting the building. Basically, there's a river that goes around it, and the whole building, one of the main buildings, is literally on an island. They said, we're having a swim race around this island to see who comes in first. And I was like, what are you talking about? And they said, you can sit here in the room and just wait for this to end, or you can participate. And I said, I'm definitely going to participate. And so in the middle of the interview, They took me up to their gym. I found some gym clothes, and I went and I did this race, and then came back and finished the interview.
You actually swam?
Yeah, because I figured at the time, I said, "Listen, I'm probably not going to get the job, but at a minimum, this will be the most interesting interview that I've ever had in my life."
That is awesome.
And then,
good for you.
and then one of the other CIOs who I'd already interviewed with, Greg Jensen, was out there, and he said, "I saw him. He's very quick on his feet." And I said, "Greg," I said, "so if I swim this race, are you going to give me an interview?" And in a nanosecond, he turned and he goes, "You swim the race, and then we'll talk about whether we give you the job."
Oh.
And so it was like a test. So anyways, that was so then I started at Bridgewater, and then I worked there for 16 years. And over that time,
okay, so
it's, for those people who are less familiar with Bridgewater, it's the biggest hedge fund in the world, and they have what is described as a systematic trading process. So they use fundamental logic, and then they convert it into rules, and they trade across most liquid markets in the world. And then they have got clients all over the world. So I spent some of my time talking to the clients and some of my time doing the research and helping the CIOs.
So you shared a story with us about Soros and what made him so great. And then you had the privilege of working for even longer and much more closely with the other true kind of titan of hedge funds, Ray Dalio. What made him so great, in your opinion?
I think, and there's an interview on my podcast. Ray was kind enough to come on the podcast. I talk with him about his childhood, growing up, and his whole background. But from my perspective, Ray is an unbelievably deep thinker about the very fundamental cause-effect relationships that drive growth, inflation, and the pricing of assets. And the whole time I worked with him was willing to spend an inordinate amount of time to get that right, both the process of zooming out and then going down to the details, which is a very difficult process. So if you compare him to somebody like Soros, as far as I know, wasn't systematic at all. Excellent synthesis, unbelievable synthesis, but it was all in his head. Whereas what Ray was trying to do was get what's out on his head onto paper, and that creates much more institutional stability than if it's just around a single person.
Yeah, and it's based upon more than whether your back was aching that week.
Yes, right. The classic story about Soros was he'd write books and books and books about why he got out of his trade, and then one of his sons said the true reason is when my father's back is aching, he gets out of a trade. So there's obviously pros. I mean, what Soros did worked well for him, and what Ray does, has served him very well. So it's different strokes for different folks.
So why don't you tell us a little bit about what you did there in terms of, first of all, how was it moving from the sell side to the buy side?
It was an adjustment because, and probably it was a very specific form of it, but the sell side, you're essentially driven by constantly needing to do the next transaction. That's how you pay the bills. Basically, a commercial bank is a toll booth, and you're just trying to move people through the toll booth and collect the toll. But you don't have any, I wouldn't say people at the bank I worked at had any deep understanding of how the world worked because they weren't incentivized to do that. The treasurer might think about the shape of the yield curve and when to loosen loan standards or not, those types of things. But they weren't really thinking holistically about how things fit together. And what I loved about Bridgewater is that they were. And they'd also spend time to train people. So the areas that I was very weak in, like understanding commodities well or equities, we had thorough training and a lot of work on that. And so it added up over time to develop a much more rigorous, I would describe it as framework-based view of the world. So framework view of what actually drives growth, what actually drives prices, what drives inflation, and then thinking about each asset class structurally about how they are and then how they're all interrelated. And then you need to relay that to how the world is structured. So how's the political system here versus the political system in China? How's that going to influence regulatory stuff? It all seen through the prism of prices. So it was a big change, but for me, it was a great that type of environment was much more suited to how I'm wired than the sell side was.
And although you came originally as kind of more of a portfolio manager or I don't know how to describe it, something more market focused, you actually ended up taking a bigger picture view of things, and you kind of went full circle and you came back to Russia and China. Is that correct?
Yeah, well, I'd say that, so first of all, strictly speaking, there aren't really portfolio managers at Bridgewater. There's just an investment process that people contribute to.
Okay.
And the ultimate, at least when I was there, I think it's changed a little bit. I've left 2 years ago. It's changed a little bit since then. But basically, what got put in the system was approved by the CIOs, but a lot of people contributed to that. And the key things to running a hedge fund is basically good returns and happy clients. And so you had to do both of those things. And that in that time, I did do, spent a lot of time on China research, Russia, but also just thinking about all the major economies.
Okay. And so you spend how long there before you decide?
16 years.
16 years. Oh, it's a long, long time. And then, so a couple of years ago, you decide that's it. I want to go back to writing. Is that ultimately what drove your kind of next chapter?
Yeah, I would say, I mean, to be quite blunt, it was I'd say fear of death, which I know sounds stark, but I was 52, and I hoped to live a really long life. My grandparents lived a long life, but my parents didn't, and I always was aware of how short things were. And while I really cherished my relationships at Bridgewater and still maintained them, I wanted to see, if I went out on my own, whether I would get a different perspective on life. And if you go back to the very beginning, I was just trying to understand how things work. And one of the things that I hadn't understood is the perspective if I was the entrepreneur, as opposed to if Ray was the entrepreneur. So I knew Ray's path very well, and I talked to them a lot about that, but I'd never gone down that path. And I wanted to try that before I died.
Oh.
And that had different elements to it. Some of it had to do with writing and creating stories that I would think put into perspective this understanding that I had about the world and share that with other people. And some of that had to do with managing my own money and beginning to develop my own unique process for how I wanted to invest, and doing both of those things.
Okay, so a couple years ago, you say, thank you very much, but I'm going off on my own. You're still I take it you're in Connecticut?
Yes, I'm still
didn't move?
Travel a fair bit, but I'm based here.
Okay.
Yeah.
And you go off and you write your first book. Why don't you tell us about it and kind of what that process was like and what it was about?
So the first book was about being a parent, and it was a nonfiction book. And I actually was writing it while I was at Bridgewater, when I was on airplanes, et cetera, on weekends that I was putting together. So it took a long time to write. The book is called Raising a Thief, and it is the story of my wife and I have 2 children, one of them biological, one of them adopted. And the adopted child had been very terribly treated before we took her into our home. And then raising her was an enormous challenge. And so it's basically about that process. And the thing that was super powerful for me about writing a story like that is the markets are fascinating, and that feedback learning loop about trading is fascinating. But I also found writing a story was a completely different vector in terms of understanding life. And this specific story, a lot of people on the outside said, oh my goodness, he's a senior person at Bridgewater. He's living in Connecticut. What a magical life. And we are very, very fortunate. But we were also struggling like crazy with this. And then when people read the book, so many people came up to me and said, who I hadn't known their stories, and said, well, okay, well, you had a really difficult parenting experience. I've got a sibling who is schizophrenic. I've got a mother who is an alcoholic. My so-and-so was in jail. So all these people around us, the markets are really deep understanding of life. But so too is just understanding the struggles of everybody around you. Everybody.
Yeah.
Everybody has, I don't know you well enough to ask, but everybody has their struggles. It's just a question of what is. And most people don't take the time to write a book about it. So I did. And when I put this thing out there, it's like a ripple that sort of goes out in the universe. You get these people writing in from all over the world when they read it. It's been translated into a bunch of languages. And so that was a very powerful way of sort of existing in the world that I'd never experienced if I hadn't written the book. That was the first book.
Did that surprise you?
Yes, it did. Because when you're writing a book, the weird thing with there's a parallel between markets and sports, and that they're very measurable outcomes, and you can measure them pretty quickly.
Okay.
Like if a person is a good, whatever, pick your sport, tennis player, baseball player, basketball, like you could actually measure how good they are at these things. Trading is the same way. You can measure yourself. Writing is one of those things that's much more subjective. I think the only real test is time. If a book is read 10, 15, 20 years later, 100 years later, it's an exceptional book, and that's very, very rare. And so knowing whether you've done something that is worthy or not is much harder to say. But I think when you get that response from people, I know it makes me feel like, okay, you're on to something. So yeah, the response surprised me, happily surprised me, and it gave me the energy to write the second book.
Okay, so the second book, though, you take a completely different tack, and you go from writing nonfiction about your life to something that's fiction. But I'm guessing that there was elements that have, the aluminum smugglers in here.
The understanding of the aluminum smuggler was in there. So I was at a dinner, and Paul Volcker was sitting next to me, and I asked Volcker if he went to Russia anymore, and he said to me, "They killed my friend, and I stopped." And it was such an interesting comment. And what he was referring to was the murder of the deputy central banker in Russia. And that comment really sparked an idea in my mind about, it's just one of these things that happens in Russia where, like, okay, deputy central bankers get murdered. But if you think about it, like, it wouldn't even, at least for me, it doesn't even dawn on me that there's a threat to the life of Federal Reserve officials. But that happened there. And I used a fictional retelling of that story and sort of went from there about how to describe a convoluted plot, an effort to solve this murder that spins into a much broader description of what's going on in the world.
And what other kind of, without giving anything away, what other elements of what you learned in Russia kind of are in there? What else can you tease us with?
I think that it's one of the things that when I was spending time in Russia and China, we have a lot of, there's sort of forces of light and forces of darkness in places like that. And the forces of light, I would say, in all these places now, there's modern technocrats that would have much more in common with you and I, and probably many of your listeners, than they would with people in the provinces in their country. So if you're talking with people in the Ministry of Finance or the central bank, they'll be very, very thoughtful, analytical people. But the big force in both Russia and China that we don't have here, that I think is very difficult for people to understand, is the secret police. And I did a lot of research in trying to understand both, in using all my language skills and context and everything, how those forces really operate. And I wanted to create a story, like if you just write a nonfiction book about it, there's limitations to that approach. There's the thing you could do in fiction, which you can't do in nonfiction, is you can guess what the psychological motivations are of everybody around the table. When I'm talking with you, I can guess what's going on in your head, but I can never definitively say. Fiction allows you to do that. And so I was thinking, going back to this original thing of just trying to understand the world, through fiction and through these invented characters and what their interactions are, I could paint that picture more vividly if I could pull it off, than I could in any other approach I did. And so it's obviously a ton of work to take a book like this, but to create a book like this. But the initial reaction from readers is super positive. And so that's, it thrills me.
And so up until now, you've been a reporter, you've written nonfiction, and this is fiction. I'm just wondering about the process, like going back and forth with your editor. What was that like? What were you surprised about? Or what was the thing that surprised you most about writing fiction?
That I could get paid, so to speak, for making stuff up. Like if you are we allowed to use profanities on your podcast?
Yeah, for sure.
Okay. that you could get paid for making shit up. I was like, this is the most unbelievable thing in the world. Because when I was working for Dow Jones, they had a thing that if you had 3 factual errors, you were fired.
Oh gosh.
It was that strict. And so when I put out stories that probably nobody was reading, the attentiveness that I went to make sure everybody's name was, double calling up.
Oh,
Your
like you
name is
mean
gonna
if
be
you
in here.
misspelled it, that was one.
That was one.
Oh my gosh.
You could not make you. That was a thing. And so, and then at Bridgewater, if you look at the raised principles, et cetera, it's all about raw, unvarnished truth. And so I was in this environment for a long period of time, professionally, decades, where making something up was suicide. And then here you could just sit in a room and you could be like, well, the character ought to be like blah, blah, blah. And you could invent these characters to tell a story about how these places that I'd never been able to do before. And then, this is going to sound kind of odd, but it's true. After you've written and rewritten and really lived in this, the characters become almost like real people to you. You're that familiar with them,
I believe
how they would respond to things.
I believe that because I feel like that about. I've never written a book, but I feel like that about just reading books.
Yeah. If it's good, that's what happens. And if people get carried away by that. So one of the people that read it was one of the people who's the character of the book is a guy named Chortnikov, who I created, who is a very senior guy in the FSB. And I shared it with a friend of mine who is in the intelligence services here, a former intelligence person here. And he was talking about Chortnikov as if he goes, well, you take somebody like Chortnikov, and I could see that the character was as real to him as it was to me. And I was like, ooh, this is working.
Oh, that's great. That's terrific.
Yeah.
All right, let's talk a little bit of markets. Because one of the things that you do, apart from writing fiction and nonfiction books, is you also write a Substack about your investment process and what you think about the markets. So first of all, why don't you just tell people what that's called, and then we're going to get into your actual kind of recent views, and we'll talk a little bit about what you think.
It's called Things I Didn't Learn in School. And there's a written piece that's about macro, and then it goes along with podcasts that are sort of individual life stories that fit within that overall narrative.
All right. Okay. And so let's get into it. Why don't you tell us or explain to us how you see the recent development of the last, let's just say, 6 months in terms of what the market got so wrong in terms of the rally that we now see is coming back in, and some repricing in terms of inflation expectations, and just kind of walk us through what you think has happened over the last little bit in terms of how the market has evolved.
Yep. So I think the simplest, I don't think I can compete with Soros in terms of having the one sentence summary. But essentially we had a massive one-off shock that people spent a lot of time looking in history to find similarities to. Oh, it's like the 1918 pandemic. Oh, it's like the Volcker tightening. And I don't think it was quite like any of those things. And I think that we have had, as investors, have had a hard time pricing this. And the central bank, as a result, has had a hard time figuring out how to calibrate how much money to create in response to that. And that's been the central struggle. So if you look over the history of humans over thousands of years, nobody has ever, ever, ever figured out how to determine how much money to create. Every system is flawed. You're on the gold standard, doesn't work. You're on the fiat standard, doesn't work. And so basically this shock sent people looking in history for explanations. And I don't think that was, and so that led to a bunch of false theses, but I don't think that history was that useful. My base view about what's going on right now is we've had a massive repricing of assets based on a notion that inflation might be getting out of control. It's not getting out of control. And for investors, I think you actually have a gift, which is that when cash rates yield 4.5%, this is an unbelievably attractive, I think, from a medium-term perspective, point for traders or investors to hold assets. And whether the debate right now is the rate at which inflation comes down relative to the rate at which growth comes down. And there's a lot of different plays that could play out. But the big picture, I think, is we had a shock. We had an overreaction based on a belief that something terrible was going to happen. It's not happening. And now today, as we speak, on January 13th, you've had an expansion of risk premiums. And I think owning them from the medium-term perspective is relatively attractive thing for investors.
Why are you so convinced that inflation is going to not be a problem over the kind of medium term? And we can all acknowledge that it's coming down. We all can go look at the break-even curve or the swap curve, the inflation swap curve. We know it's coming down, but kind of one of my thoughts that I'm kind of thinking about is 2% used to be kind of a ceiling that we had trouble getting above. And one of my arguments has always been that ceiling will likely become a floor. And by the sounds of it, you're like, no, we bumped way up higher because of, I'm assuming you're attributing it to in kind of supply side shocks and the COVID stimulus. And we're going to come back. And do you foresee a situation where we go back to the period where 2% is the ceiling as opposed to a floor?
Or the midpoint. I think it's possible. So I think what happened is we had a supply-demand shock. And the demand shock was that this boom we had was not driven by typical expansion in private sector credit.
Agreed, yep.
It was driven, like you're referring to, of the government giving money to households and then spending it. And then that was the demand side of it. And the supply side of it was the supply chain kinks, but also a huge part of this, I think, and I've been doing more digging on this recently, is the interruption in the flow of people. So if you look about the imbalance that's in the labor force, a lot of that, and it's not only in the United States and other countries as well, has to do with the interruption of people. And I think as we sort of normalize now even in China, as that flow of people picks up, you're going to be left with a world that's not that different than the world we were in before, which is the overall potential growth of the economy is not that strong. It's a little bit strong in the United States because of positive population growth, but productivity is not that high because the current round of inventions we have aren't that life-changing relative to things like electricity and antibiotics and railroads. So the overall trend level of growth is relatively low. In many parts of the world, take a place like China or Japan, the population or Russia, the population, or Europe, the population is now shrinking. That's not true to the degree in the United States because of immigration. I think immigration saves us and makes us a more attractive place to invest. And so the overall level of income growth is not going to be that strong. The overall level of debt growth is relatively high globally. It could pick up a little bit in the household. And if you put spending as being a function of income and borrowing, there's not that much juice if you're not doing fiscal transfers to be able to create an income boom. So it's hard to create much of a spending boom. And as that happens, the more likely path, I think, is that inflation is relatively low.
What about the argument that COVID has kind of lifted the veil in terms of fiscal spending? And if you kind of compare the response to the great financial crisis when we had Tea Party kind of constraints on the economy versus the COVID spending, what if this is the new response to any time the economy gets into trouble? Instead of trying to fix it monetarily, we fix it fiscally?
I think these are obviously real risks, and as an investor, nothing is a certainty. So I think you'd have to watch that. I think the more likely thing is now that we've seen that how delicate the equilibrium is and how quickly inflation can rise if you begin to give away money and interrupt the flow of people and have big blockages at your ports. It's like you can see things much more clearly when they fall apart. Larry Summers had this line that the modern global economy is a little bit like one of these a modern airplane, which is most of the time, it can fly you from LA to Australia in absolute comfort, and it all looks perfect. But then sometimes there's these horrific crashes where all of a sudden, the plane is on the ground and the guts and everything, and you're like, what possibly happened? It's a little bit like that. So I think that after the rise in inflation, I think that politicians understand that anybody who this can be pinned on is done. That people will very quickly switch their worries from China or international politics or identity politics. The minute that they're spending tons of money for simple stuff, that becomes absolute kryptonite for any politician that is in control. So my sense is that this experience of how quickly inflation can shoot back up if you leave these processes and begin to do that will change people's behavior. But maybe I'm being too optimistic. So I've got to, you always, one of the things I always learned in my own training, you probably learned too, is, and watching great investors, you always have to be open to a huge range of possibilities.
Oh, yeah.
So I think the most compelling thesis for me is we had this interruption. It led to exploding inflation. It's going to be hard. I don't think a forensic accounting has yet been done of all of the forces that were involved. And I think we'll get it with time, that led to this, an attribution of each of the moving parts that led to the spike in inflation. But the more evidence I see is that it was that combination of one-off things happening at the same time. The war certainly contributed to that. But now, as those things recede from the past, I think that prices are likely to come back down. And I also think that the level of technology we have right now, while nowhere near of those inventions I was speaking about before, I do think it's pretty compelling to come up with labor-saving technology if this really persists. So if I'm wrong about the immigration coming in and opening back up and depressing wages in restaurants, and obviously construction is very weak, but say service jobs broadly, I don't think it'll take that long to be able to come up with technological replacements. You'll stop dealing with waiters in cafes. You'll just deal with everything on iPads like you did during COVID. And that can change fast if it'll persist. So I don't think we're going to get to that. But I think the most likely is a massive interruption that we're now getting over. There is a question about the pacing at which that happens, which I think is tricky. And trying to get those portfolio bets right in your portfolio. How much is a recovery in risk premiums in general, and how much of it and how sustainable are those cash rates and the pacing at which that happens, and then what hedges you put on if the pacing is slower than I'm thinking. Those are all really important questions for managing money, I think.
And what about the idea that we had the end of that kind of growth trade? We saw the FANG mats. It almost felt like a euphoric high in November of 2021 in terms of people reaching for growth, but over the last 6 months they've gotten killed, after the last year they've gotten killed, and value stocks have been doing better. In your scenario, would you see a situation return to the growth stocks, and we see a bid come back into those FANG mats?
Not necessarily, and I'm fascinated by single stocks. I wouldn't say a lot of my risk is, I have some single stock positions, but not a lot of the risk is in them. Personally, first of all, I should say this is not investment advice. I'm just sharing with you what I'm doing with my portfolio. Your people can take it or leave it. Investing is very risky, and I've certainly lost money, and other people could lose money investing. It's hard, but I would say my own portfolio is much more tilted to value right now than having any of the growth stocks in it. I think the growth. We basically had two tech bubbles in my investing lifetime, and I think it actually speaks to the same process that I was speaking about with COVID, which is, as humans, we have a really hard time pricing something that is new, that we don't have templates. We're basically trained as humans for pattern recognition. And pattern recognition helps. It's certainly, studying economic cycles, boom busts, and all that stuff, it's invaluable as a trader. However, when you get new pieces of information, trying to put the right price on it is awfully hard. And it can lead to weird self-reinforcing furies like the tech one and like all the other bubbles in history, and then this most recent one as well. And And I think it could easily lead to another one in AI. In other words, all the growth stock pictures, it's like they need some new thing to get excited about. And now they're talking about AI and Chat GPT and all that. And I look at Chat GPT and I'm like, it's pretty cool. I don't know how you make money off of that, though, necessarily. Though, maybe there's a huge opportunity. So I personally don't like stocks like that because I don't, as a rule, trade anything I can't understand.
Okay.
And so what I can understand is very, very simple businesses. Like the business is worth $100 if you look at, and it's trading for 80. I like businesses like that, and I'm willing to wait, and I feel safe, and I've got a margin of error, and I'm not looking to get 20% returns. I'm looking to get stable, 8-9% returns.
One of the things that's fascinated me recently is kind of vol controlled funds, and obviously risk parity is a kind of an element of that.
Yep.
Could we just talk about that philosophy of managing money? First of all, is the vast majority of serious long-term money have some sort of vol control component put on it, you think?
I'm not exactly sure what you mean by
well, the fact that well, if we just take like an S&P 500 vol control fund that says as vol goes up, we reduce our exposure, and risk parity to some extent, if I'm not mistaken, there's an element of vol control. Volatility is affecting your exposure to it, and obviously correlations in there as well. But
probably not. So I'm not an expert on the vol control fund.
Okay.
So those types of things tend to make me really skeptical.
Okay, so let's just talk about that. Why do you feel that way?
Because it's not direct. You're introducing too many different bets into your portfolio. So I like to have the portfolio just be as simple as possible, and because then I can understand the risk. In other words, if you think that the Fed is not tightening enough, a 1 degree of separation bet is I'm going to short Fed funds futures. They're discounting 25 basis points. In reality, they're going to do 1%. That is like as direct a bet as you can get. A secondary bet would be doing something like, no, I want to short the S&P. Because what's going to happen is that I think PEs are going to go down in the long term. It's going to affect earnings. That's not the bet that I would be taking. And then once you introduce vol funds into an option, things like that, you've got bets upon bets. So you're betting in this case upon the Fed. Then you're betting on the supply demand for vol, and it's
that's not a vol. The vol control fund isn't looking at realized volatility and doing your exposure based upon the volatility of the actual underlying asset.
Right. Okay.
So
but then that can evolve over time, and so it's like how much is the vol being controlled by the supply demand in terms of what people are looking for in the options market. So I try to avoid things that have complexity. Risk, what people call risk parity, I would basically describe as not a vol control thing, as just renting out your money.
Okay, could you explain
You're
that?
basically saying, listen, there's cash and there's assets. Over time, assets ought to outperform cash. And the reason they ought to outperform cash is because for capitalism to work, you have to incentivize people to get a higher return for renting out their money or keeping it in cash. If cash outperforms assets, you're in a depression, which is why those periods of time don't last. So cash was great in the Great Depression, and it was great last year. And the reason it was great last year is because the Federal Reserve was changing what the pricing was of risk premiums. So as they raised rates on cash higher than they were discounted, that then changed what the discount rate was across the whole bond curve, which then changed the PEs that stocks were trading at. And everything had to reprice. And if you look at it in sort of vol-adjusted terms, everything came down by 20%, roughly. The only thing that they're doing in the risk parity stuff that I know is obviously the Bridgewater stuff is intimately. There's no complicated vol target. It's basically what you're saying is you want to hold things in risk equivalent terms. So if you hold a 60-40 portfolio, the vol of the stocks is much higher than the vol of the bonds, as opposed to holding 10-year bonds. If you hold 30-year bonds, they're roughly the same risk as stocks. That's all. That's the only concept. And I think that concept, was a disaster last year because you had risk premiums rise. But over time, that concept is a really safe way to invest. I think makes a lot of sense.
And so you don't think that it's been the end of risk parity?
No, I don't. I think that last year, the stocks and bonds did terrible for totally logical reasons, which is that the Fed was way behind the curve and investors were way behind the curve thinking what the Fed would do and how bad inflation would be. So it was a classic surprise. And when you get a surprise, you get a repricing of cash rates. That repricing of cash rates translates into the pricing of all other assets you could own. And that's why they all fell that much. But now your starting point as an investor, say you were last year in cash, or you, even better, you shorted. Now the question is, going forward, what is your starting point? And when I look at what's going on now, pricing in Fed rate cuts later this year seems a little bit odd to me. It seems to me what they're, I think the more likely thing is they raise rates a little bit more, than they just stop and watch. So the shape of the yield curve seems a little bit odd to me. But if you look from a medium-term perspective, there were unbelievably low risk premiums on assets, and I'm talking stocks, bonds, everything, mostly driven by an incredibly depressed real interest rate. That is now repriced. And from here, I think that investors have much more favorable wind going on their back going forward than they did in the past. And the repricing is super, why did that happen? What was creating the inflation? It's a strange feedback loop because some of the tech companies are creating the inflation, creating the disinflation, which then drives their prices up later. So breaking something like that was complicated, but it's been broken, I think.
Could you explain to me in terms of when you see the risk premiums on bonds and you're saying that they got elevated? Because are you talking about the term premium? Because everything I see on the term premium actually indicates that it's still negative, and it's kind of one of the conundrums that people don't understand.
Well, I think the big thing I'd focus on is real interest rates.
Okay.
So if you look at real interest rates on long-term bonds, they were negative 1%, and now they're 1% positive.
Okay.
The shape of the yield curve is, I think, off. But there's obviously different ways that could shift. In other words, the short-term rates could come down, the long-term rates could rise, the short-term rates could rise further, the long-term could be dragged up. But I think so there's a short-term thing about the way you want to trade the curve. And to me, if I look at those long-term rates relative to the short-term rates, they seem off. And personally, I think that there's an opportunity there. That's one perspective. It's also important, though, to zoom out and have a longer-term perspective on markets. And we had many, many years with negative real interest rates, and now you can get positive real interest rates on a lot of assets out there. And so I think the possibility for just owning long fixed income in relatively safe assets that are earning 5, 6, 7, in some case 8, 9% yields is way more attractive than it was a couple of years ago. So I think both things are true at the same time.
Okay, well, that's some fascinating stuff. So why don't we kind of finish up here with our 5 questions that we like to ask everyone. So let's start with your favorite investment book.
So I've read a lot of investment books, but I'm going to give you an investment essay instead. So, and this is from things that I've learned since I've gone off. So probably the most famous living American novelist is a guy called Cormac McCarthy. Yes. And he wrote this essay that you can get that's called The Kekuli Problem. I wrote about it in my Substack called The Problem Solver Within. And it's basically, I think it's a fantastic essay about the unconscious. Why is that incredibly important for investors? Because everything that we know is in the price of the assets that are on the screen today. So to come up with a really good trade, you need to be thinking of something that's not in the price of the asset. And that is actually a creative process. There's analytical work to get the right answer, but coming up with those questions is creative. And Cormac said something really fascinating in the essay. And he said the unconscious, we don't understand it, but it'll solve pretty much any problem we give it. And so I think as investors, Ray was a big proponent of meditation. making time in your life for that creative process to have room to breathe is actually critical both for risk management and for good opportunity seeking and investing.
That's a great answer. Okay. Number 2, are great traders born or made?
Born.
Oh, wow.
And I thought about it a lot. And there's so many people I know who have had excellent investment trading and are terrible investors. And so I think that the tricky thing with investors is the really great ones. It is a real combination, I think, of left brain and right brain, and that's a very, very rare skill, because you definitely need to be analytical to understand things, and there is a huge creative element to it. And how you marry those two things together, I think, is rare.
That's interesting. All right. Don Cox used to say that you shouldn't invest on what's on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any Don Cox type investments for us today?
Well, I think one of them is the idea that the storm is past, and actually holding asset risk is more attractive than it had been, I think, is one of them. And then within that, if you dropped out, I think certain things like, this is going to probably sound pretty esoteric to some of your listeners, but things like Australian inflation-linked bonds are interesting to me.
Okay,
So these are things,
why Australia?
So a couple different things. I think we've had a dollar squeeze here that's gradually, again, this is not like a 2-month trade. This is like a medium-term perspective that is gradually going to abate. If you look at something like the Australian dollar, so first of all, you're buying the asset unhedged. So there's 3 different moving parts. There is a currency part, there's a real yield part, there's an inflation part. So I think the currency is undervalued. The real yield, they've come in a little bit, but there's still relatively close to 1.5%. I think in a period of time where you're going to have relatively low global growth, I think that's attractive. And it's discounting very low inflation. It's discounting about 2.5% inflation at a period of time where Australian inflation is much higher than that. So it gives you some protection. And who knows? Well, I have my views about what's going to happen with China. But if the China opening is more inflationary, you're owning something with that inflation protection built into it. And then if you look at Australia, they're typically somebody who is dependent on international capital flows. They happen to be in a situation right now where they are providing capital to the rest of the world. So they've got a current account surplus. U.S. has got a big current account deficit. So I think you've got an undervalued medium-term currency with an attractive real yield with under-discounted inflation. And I like that combo.
That's a great idea. I like it a lot as well. Byron Wien used to do his top surprises for next year. He defined a surprise as something the market has signed a less than 1/3 chance of happening, but he thinks that's a better than 50-50 chance. Do you have a Byron Wien surprise for me?
That when we do the forensic counting of what caused the inflation, that a lot of it was that immigrants were shut off from flowing into our service sector jobs.
I was actually going to follow up on that about when you talk about the people side of the equation. Is that what you meant?
Yes, it is what I meant. And it didn't only happen here. It happened in other countries as well. So that is a surprise, and I'm doing some analytical digging on that, but I think that is a likely culprit. It's not the full attribution of inflation, but it's a chunk of it. And I think that it's a meaningful one.
All right. And then final question. What advice would you give a young person starting this business today?
Trade small, read widely.
I love that.
So a lot of times people would ask me, how do young people joining Bridgewater, how do I learn to trade? And I was like, how much money do you got? And they were like, I got $1,000. And I was like, okay, start trading $2,000 of risk every day. You will learn about trading so much faster than if you just read books. But the pain of doing stupid stuff will force you to do an examination, and it's basically an endless curriculum. So there's a strange thing about money, which is that people that truly understand it generally profit off of it themselves, as opposed to take time to explain it, point one. And the second thing is people who do write about it generally write poorly about it, unfortunately. So I've read tons of books, you probably have too. Most of them are awful. But it's like reading Soros's Alchemy of Finance. there's actually great information there. You just need to translate what the heck it means. So the combination of trading to really understand and then forcing yourself to do the homework behind the homework behind the homework is what will, I think, if you're going to have good results, that's going to lead to it. And you have to realize you're going to be studying this your entire life. So you've been at this a long time. I've been at this for decades. I could show you the stack of books on my desk right now. They're all things that I need to dig into to understand this more. And each new piece I read helps me understand. I know I'm giving a wordy answer. I'll also tell you from traveling with Ray, always stacks of books in his suitcase.
You gotta buy him a Kindle.
Guy reads constantly.
You got to
What's
buy
that?
him a Kindle.
Yeah, but it was actually interesting for me because I always felt like, oh, I'm the dummy that doesn't understand this stuff and is scarfing up all these books to try to understand. And then I was like, no. He also is constantly doing homework to try to understand. And I was like, that's how hard this is.
Oh, okay. Well, listen, this has been a real pleasure having you, Paul. Let's go over where people can learn more about you and learn about it. So let's start with your Substack. What's the name of that again?
Things I didn't learn in school. Or if you just go to paulpodolsky.com, my last name is Podolsky, you can see all that. It has links to everything.
You have a terrific personal website, by the way. I don't know who made that.
Oh, thank you so much.
It really was. I was like, oh, geez, this is well done. Okay, so paulpodolsky.com. And for those that are kind of more podcast or YouTube oriented, what's the name of your podcast? Where can they find that?
It's also called Things I Didn't Learn in School, and it's on Apple Podcasts, it's on Spotify, it's
okay.
everywhere.
And your publishing company would be very upset if you didn't talk about your book in the final thing here. So the name of the book, where they can find it, and all that good jazz.
It's called Master, and then comma Minion, and it's available on Amazon. It's available in your local bookstore. And then the other book is called Raising a Thief.
That's great. Well,
and thank you for taking time to chat with me and give me an opportunity to discuss things with you.
It's been my pleasure, Paul, and we hopefully will have you on again because I've learned a lot and looking for. I have a whole list of other questions I wanted to get at, and I realized that we were
that's good.
We're already an hour and 15 into it. I better cut it off.
What if Bridgewater's a salesman who unfortunately passed away, but taught me a lot too? He's one of his basic precepts. I was like, how do you do it? And he said, always keep them wanting more.
That's a great line. Anyway, thank you again, Paul. Okay, Patrick, time for talking charts. What do you have for us?
Okay, well, last week, it was only a week ago, we were talking about the short squeeze, whether it would continue, and so far it has. We were talking about oil, whether it would follow through on its selling. And number one was whether inflation was going to be a market mover. What's your take on the inflation numbers?
Well, it was pretty well spot on, but it was interesting the reaction to it. And one of the things that you should always remember is that maybe the news about the actual economic release or the earnings result isn't as important as the reaction to it.
Right. And so really, just touching on the short squeeze in oil, obviously the stock market broke the trade range to the upside and more or less is now coming to a very critical level around 4,000. But it really, this moment is alleviating a lot of that very bearishness, that strong bearishness we had over the holiday season. And oil never followed through. And one of the interesting, actually, we'll put up a chart of oil here in just a second, but let's talk about the top 3 things to watch, not just next week, but for the next 2 weeks, because that's next time we're at the end of the month going to do our next episode. And the first thing I wanted to talk about, Kev, is number 3 thing to watch is global equity. And while we stare at this S&P 500, and asking the question whether or not it can go back to its December, November highs, there just have been a couple global equity markets that have just been on fire. Like one of them here, this is the Euro stock, which Europe just continues to rip. It's not just that it's going up and that it's broken those December highs, it's the velocity from which bullish. It's actually doing it. It's almost aggressive buying that we're seeing there. But what's interesting is it's not just the Euro stock, but I don't know if you've recently looked at what's going on in the FTSE in London, but we're talking about fresh 52-week highs in London. And so while we kind of are all muddled up in this U.S. bear market, some of these global indices are running away here. Another one, which was something you've talked about extensively and put on the radar for me anyway, was Mexico. And that, while it had a correction over the holiday period, has also just ripped to a fresh new 52-week high. So it's interesting that, we kind of are always looking at things from a U.S. equity lens, but some of these global equity markets are just running.
I'm going to channel my inner John McClane and say, welcome to the party, man. Or pal. Welcome to the party, pal, not man. Yeah, Patrick, I've been saying this for a while. Everyone's been so focused on U.S. and the U.S. And I contend that it's the most over-owned market, and that eventually money would flow into other different equity markets. And all it would take, and everyone would always say to me, well, wait, how can you be bullish European banks? They're so bad. How can you be bullish Japan? It's a terrible
Well, Japan's
market.
been muddled, actually.
My point was that those other countries don't have to be good. They just have to find that managers are wanting to go back to benchmark, and that would cause a rally in itself, meaning that people were so overweight US for so long, all it would take is a return to bench for these other markets to outperform. Yeah. And I think that's what you're experiencing now. Even though everyone thinks that all this money is going into all these different countries, I think that a lot of this is international investors going back to bench. And the massive overweight of the U.S. is coming off, and it's getting redistributed back into these other countries, and you're seeing monster bids.
Another interesting one of these global equity things, just looking at the emerging market basket. This is particularly the EMX ex-China, because the other EM has too much weighting of China to kind of get a clean kind of perspective. But it did not make a lower low, and it really starts to feel like it's putting in some sort of a bottoming formation. And one of the sure tailwinds of these kind of markets has got to be some U.S. dollar weakness, and maybe that U.S. dollar weakness is really demonstrating that shift of that money flow, right?
For sure. And is that what I didn't get to set the actual top 3 things to watch?
Well, let's move on.
So I was just wondering, is that going to be number?
Yeah, we're going there. Okay, so number 2, we have earnings season. I mean, the golf ball and the garden hose is going to happen in the latter part of the 2 weeks, but we're definitely in earnings season. And the thing is that, of course, these companies are going to be coming out with weak numbers. The question really is how much has been baked in, and could the market actually potentially bullishly react to the numbers not being as bad as everyone thought they could be? I don't know. I'm not necessarily making that call, but we are going to earnings season. That's certainly the thing to watch.
I think you meant pig in a python, but I'll just let that go.
Golf ball and a garden hose.
Yeah. Okay, buddy. What is number 1 thing we're going to watch?
Number 1, we got to talk to Japan.
Oh, it wasn't the U.S. dollar. Oh, here I was thinking it was going to be the U.S. dollar.
Oh, you would think, right? But no, we had to talk Japan. It's obviously it's been a bit of turmoil in that market, right? Certainly, I was reading a recent piece from Russell Napier saying that something has broken and that like phase 2 of financial repression is near in Japan. And essentially, they tried to obviously run a tighter monetary policy by allowing interest rates to rise, but supposedly, at least it's appearing as though that has backfired. What's your take on what's going on there?
So what Russell's saying, like, I just want to understand because I haven't read his piece. His argument is that they've tried to
Basically,
they tried to tighten policy, and the market's running ahead.
Well, essentially, the Bank of Japan balance sheet is now expanding rapidly to maintain this new yield.
Yeah, because the market smells that they're about to go and allow rates to move off of the yield curve control, so they're pushing it and they're creating credit. And one of the things that I think is interesting is that everyone's losing their shit about this, and I don't see any reason to get that excited about it in terms of like it's not some traumatic event. There was always going to be trouble getting off of the yield curve control. Like that was always the joke about it, is that it's easy to get on and it's hard to get off of it. I just think that it'll be a painful rip the Band-Aid situation off. And in the meantime, as they're sitting there defending the yield curve, limited yield curve control that they have, they're creating more yen. So this is terrific in terms of if you're a Japanese stock market bull. This is
well, it
this
hasn't
is in
reflected
essence,
in the Nikkei.
Yeah, listen. It's difficult over the short run, but over the long run, I believe that if I told you, Patrick, that the government was going to do massive quantitative easing in the United States, what would you do? You'd be like, I'm running out and I'm buying spoos, right? Because it's liquidity.
Yeah, but the raising of the rates was actually an attempt to create tighter monetary policy, and you're arguing that this is an expansion of monetary policy. I mean, their balance sheet is expanding not by intention, but by the byproduct
so they're going to get
that they
more
have to
inflation.
defend.
They're going to get more inflation, and their economy is going to be stronger, and it's going to be.
Well, the argument again if I'm paraphrasing Russell, I hope I accurately capture his thing, but his argument is that phase 2 of financial repression is where they're going to force these savings institutions in Japan to actually now start buying and owning these JGBs on their balance sheets, which is going to force them actually to start selling assets abroad and actually create stress among the things. So actually, his argument is anyway.
So he thinks this is the a risk-off situation. The fact that the Bank of Japan is losing control of
if the phase 2 of financial repression happens, then that is definitely risk-off.
Yeah, well, and I do think that to some extent that you're going to find Japanese institutions that were previously investing abroad are going to come back home. So I do think that's going to occur. I just don't think it's the end of the world. And in fact,
I mean, come on, and most things aren't the end of the world.
Well, but not if you go listen to the other podcasts that you cheat on me with.
Well, Russell,
there's a different end of the world every week. But anyways, I like Russell a lot, and I'm sure his is much more nuanced. But I just think that everyone is now losing their shit about this. And the other thing that I think is interesting is it was only 3 months ago that everyone said that shorting these things was a terrible trade. Owning the yen was a terrible trade because the US dollar was going to go straight up forever. People were saying that the Japanese banks are dead money. They're never going to go up. Then meanwhile, look at it. Go pull up the Japanese Topics Bank Index. It's up 30%.
Yeah, but okay, the bank index has, but you can't say that about the broader equity market in Japan. Like the Nikkei, here's the chart on the Nikkei, and that's been stuck in the mud, right?
Yeah,
I get it. Your bank index has been doing great, but you're cherry picking. I think
it's gone sideways. It's not like it's collapsing. I'm not as fussed about it all. I think that they have to get off YCC. Do I think it's going to be bumpy? Of course it's going to be bumpy. It's going to be difficult. They probably should just do it quickly because the market kind of smells blood now and everyone's putting on the trade. It's one of these things that once the market senses that you're about to do it, you actually they push it there all right away. Like if you look at 10-year Japanese swaps, which is in essence the rate upon which banks lend to one another over term, it's already at 100 basis points. So it's already double what the 10-year JGB market is in terms of yield. So we got two 50 basis points already there. I think that they should just, rip off the Band-Aid, because once the market smells something that, a peg that is about to break, they just go break it.
They go and break it.
That's why
that's why it's number one. That's why it's number one on our list.
But to some extent, that's why governments, until the moment that they're prepared to break a peg or to break a YCC, or even for that matter, Jerome Powell. Everyone's having trouble right now because he's gone from being extremely hawkish to just somewhat hawkish. And everyone says, but just look at it. 2 months ago, he was extremely hawkish. And I said, well, if he had kind of hinted that in 2 months' time he was going to become less hawkish, they would actually just price that in immediately.
But you just have to do one thing. Just admit to me that you're just talking your book, because you'd love nothing more than your JGB shorts to rake you in a retirement fund, right?
For sure. Listen, I've been on that trade for a while, and I got made fun of for a long time, and now it's finally working. So I do deserve a little bit of money. But the fact that we put this as number one means that you probably have completely goochered my trade. And instead of it being my retirement fund, it's probably going to mean that I'm going to have to be working until I'm 75 because you put it as number one.
Look, I didn't put the JGB trade as number one. I simply said next week on Tuesday overnight, we're going to get the Bank of Japan talking. They're obviously going to have to respond or comment on what is happening. It's the thing to watch. I'm not goochering no trades here, buddy. Okay. I want you to retire at some point. Well, I feel for you, buddy.
No, listen, I'm sure it's going to be 75, maybe even 85 at the rate that everything's going. All right.
Yeah. What else? All right. Let's talk some charts. So let's just hit it. Okay. S&P 500. It's crawling to an incredibly important moment. The fib retracement zone is right here around 4,000. I look at this kind of 3,800 to 4,000. I'm obviously rounding the area, sort of like the neutral zone of the market move. And I think that if, for whatever reason, if the bulls can actually start next week with a little bit of momentum north of 4,000, we could see some follow through that maybe tests those November, December highs, or even the August highs, to kind of short squeeze higher. Now, that doesn't change my bearishness in the bigger picture, by the way. Don't accidentally misinterpret me. Because I was going to, I already saw the.
Lord help us if you actually get positive on the market. No. I want you to know. I think it's going up over the short run, but I still hate it.
I still hate it. I hate it. No, there you go. No, but look, you know what? Everyone was so bearish that often the market needs to wash out all the short sellers and more importantly, sucker in all the buyers to load up, and then they can be the bag holders. It's the way it works, buddy. All right, so the next thing I wanted to just touch on, first of all, that dollar continues to be so weak. I was speculating last week that we could have at least had a retracement of the dollar back to 107, 108, potentially a euro that could go back to parity, and there is zero sign of it. It's just not playing out at all. This U.S. dollar weakness is very distinctly momentum, and it has not quit. And it's obviously the U.S. dollar yen even now below the 128 level, which I thought could have potentially held. But even the euro now cleared 107 decisively. I mean, at this stage, now it's targeting levels like 110, 112 on the upside. Just substantial momentum in cross currencies, including the cross currency we love the most, which is gold. What a rip. I have to give it to you, Kev. You were right and I was wrong on gold.
What?
About gold. I felt that this kind of 1815 and 1900 level had a real chance of acting as some resistance and potentially mean reverting gold down. And you made the call last week that it was just going to keep ripping. And you were right. Patrick, you were right. I was wrong.
Well, thank you. That's very kind of you.
But now the fact that I'm long gold and silver, I'm not actually complaining. I'm saying you were right, and I'm making money. That's perfect.
Well, that's how most of my calls go. I'm right, and someone else makes all the money. I do think that I'll highlight one thing. A lot of folks are stressing that whether it be the relationship to the U.S. dollar or the relationship to real rates, and they're saying that gold is not behaving as it should. And I had one subscriber say, who's lying, real rates or the gold? And I don't think that is the right question to ask, because I really think that all those relationships might just be thrown out the window due to the central bank buying, which is a fundamental change in the gold market. So we could have a bull market in gold with a bull market in rates, or sorry, like in the U.S. dollar, and even a bull market in terms of rates going up, or actually that's a bear market in bonds. I really think that they can go on their own, and that the mistake will be to assume that all those relationships that worked so perfectly in the past continue to work so tightly.
One of the reasons why I think that your point could be is that when you really put it in the context of the size of the bond markets and the size of the currency markets relative to the size of the gold market, while gold market is gargantuan, it is nowhere near the size of the others. And so when there's genuine buying of bullion, it is just not a big enough market for on a relative basis. It could, when those money flows come, it can run on its own.
Bingo. And I think that Grant Williams was the first one that I ever saw really articulate this well. He has a presentation. I can't remember if he calls it if.
Well, you're talking about the one from like 5, 6, 7 years ago.
Yeah, a long time ago.
But I think, but was he talking about gold or gold miners? Because
he talked about all sorts of portions of it. But his argument was that if you had an allocation of pension funds that had something like 0.2% of their allocation is towards gold and gold miners, and he said if you doubled that, what would that mean in terms of the gold market? And he went through it all, and it was actually surprisingly is small. And I think that the central banks buying it. And you're spot on correct, Patrick, that, gold's a big liquid metal, but it's nothing compared to the bond market. And in terms of if the Chinese decide that, instead of owning, I don't know what the number is, let's say 1% of their reserves are gold, and that they really should have 10, which really still sounds low when you can decide, when you think about the risks that are out there, then it's going to mean just they're going to be on the bid forever. It's just going to be constant, and it's not just the Chinese. It's going to be all sorts of central banks.
Well, I'll tell you, every day that gold stays above 1,900, I'm just going to say technically, and all consolidations are bought and held above 1,850, 1,900 on pullbacks, the more likely the next bull market in gold has legitimately begun. Because often there are these kind of so gold's been in a bear market for the entire year. Right, 2022 was one big bear, and often there are bear market rallies. And there was, at least even a week ago, there was not enough evidence to say that this was nothing more than just a bear market rally. But a sustained price action of 1,900 is legitimizing a new bull trend. And so long as this isn't prairie dogging 1,900 and that it and actually sustains and holds up there, then it could really signify a meaningful new trend. I don't want to make that call one candle close above 1,900, but it is certainly a thing to watch next week or the next many weeks.
Here's my piece of advice. Stop listening to the macro kind of dual access chart gold analysts out there, and listen to the pure technical analysts like Patrick and people like that, and just trade the chart, because I think that the fundamentals will lead you astray.
All right. I wanted to go back quickly to equity, just because I forgot to mention the VIX. And here we are at 18 on the VIX. Like on the 18 handle, and sure, 2021 we saw the 15 and 16 level, but there was simply no circumstance which I thought we were going to sustain below 20, and here we are. I was wrong. It's incredible that, but volatility premium is completely backing off here. But I mean, the question I have for you, I mean, obviously, I think you've been talking about lower vol. I know this is something that was thing. But do you think that it's going to be contained to 2021, or you think that we could have a much more sustained lower vol?
Oh, I think we could be a lot lower still.
You're kidding me.
No. Go okay. So
okay,
let's go back.
But think of what volatility is. Volatility is whether you're measuring it on the daily ranges or weekly ranges or annualized, like these numbers are. The thing is that while I could maybe say that you have a chance of being right, that this is going to be much more of a muddle of a stock market than it is a bearish one. Maybe that's true, but there's still going to be volatility. I mean, when you're pricing in low teens volatility, that's basically suggesting we're going back to 20-point S&P daily ranges.
I think it could get really boring. I think we could be shocked at how
Oh
boring
no,
it gets.
I can't drink that Kool-Aid. Look, I can drink it. I can start to accept that maybe there's a chance you're going to be right about trade range-bound markets. But that kind of low-ranged volatility, I'm a seller on that idea, dude.
Well, it's okay. We're gonna settle all this up with the
bet at the end of the year.
The stake.
Yes.
Can you just pull up a little bit of a longer chart? I'd love to see what were the lows like.
10. I mean, there was a period we were under 10.
Go back and I don't think that point from 16 to 18, that was really dumb. And that got really low. So I don't think it goes to there. But I guess we did that. You know what's interesting, Patrick? Look at 03 to 07. That was just a constant drip as well.
Yeah, but 03 to 07 was a bull market, dude.
Yeah, but I think you're probably a little more.
By the way, I have no idea why I'm using the word "dude" so much in this episode. Like you've been. Okay, I'm gonna stop saying that. I can't believe it. All right, but honestly,
dude, what does mine say?
Dude,
sweet,
sweet.
Dude, what does mine say,
dude? No, but the point though is I just don't think that we're going back to.
I know you never
pre-COVID.
think that, buddy.
No. In the next bull market, we can. I'm not saying never. I just don't believe that that we have seen the end of the conditions I just think that the market has lots of room to do some crazy ass shit.
I know that's okay.
All right,
Citadel and all the other market makers love your call option buying, your put option buying. What's the next thing? Oil.
Let's talk oil. So last week it was the thing to watch, and one of the kind of things that I was highlighting was the fact that would we see a scenario where that followed through and made lower lows, or would we see the scenario that we're seeing now, which is that really shocking 2-day drop of oil that started the year was completely wiped out, and that was the case, and that to me. I don't want to say something outright bullish, but at least what this is demonstrating is that a lot of the selling pressure that was driving this kind of 7 to 8 month oil bear market is exhausted. I mean, the divergent momentum almost, this is what creates basing or bottoming formations. Maybe we are seeing the levels where the lows of oil will be in for the year.
Well, I like this talk, Patrick. I do want to say one quick thing, Patrick. Did you see that Pierre Endurant, or I don't think I'm saying it right, the big
the big oil hedge fund guy.
Did you see how much he was down the first week?
No,
it was something like 19%. I was like, okay. What's moved? I thought, okay, he must own some far data stuff that moved. I was trying to figure it out, and the far data stuff moved less. So all I could figure out is that he's long 200-300% of the front month. I was like, and I was thinking to myself, that's some real vol.
Now, you know what?
19%
Some of
in
these
a week.
Some of these oil traders just love leverage. They the types of drawdowns and then returns they make when they're right. They're the true Wild West. It's
that's why the Texas hedge. I'm long oil and I'm long calls too, and I'm short and I'm written some puts
and I'm short the puts to pay for it.
Actually, staying on energy, can you?
Yeah.
I haven't done it yet. I am so tempted to buy nat gas.
Oh my God! Thank you. I was literally going to put up that chart. Okay, but you know what? Okay, listen. I don't know the context of your interest to buy it in terms of just a bounce, because the move down towards under $4 in this $3 to $4 pocket is certainly has a very reasonable probability of housing a tradable short-term low. But what I'm trying to determine, though, is it one of these lows that comes in that just because of the seasonality and the rolling of these, this is like a continuous contract here. You know, as we're rolling through the summer month term structure of oil, which is many of these contracts are still at these lower levels, are we just going to see nat gas kind of bounce between $4 to $5 for a good chunk of the first and second quarter before something more bullish happens in the back half? Like, just because it's really cheap, do you think it has to have I mean, as a trader, you catch a move from $4 to $5. Yeah, that's a good percentage return. But I mean, do you think that in these couple first months of the year that it can do more than that?
I don't know, Patrick. It just seems really bombed out, and I kind of like the long-term fundamental story.
Yeah, but you'd go and buy a strip, wouldn't you?
Yeah, so I like trading the whole strip, and it's like
but do you just go 1 year out on the strip?
No, I might go even 2 years depending on. It's just like I buy every contract out, and for people that are like, oh, that's too big, you can buy the half minis. There's minis, or you can buy every second month. I just like it because I hate this rolling, like either rolling the front month, which I think is just a mug's
that's
game.
just
Like
you're just gonna eat it on the
or even picking out some far dated one. It just feels kind of, who knows? It feels kind of random. I guess maybe if you traded 2 years out, does it really move that much different than the strip?
Yeah.
I'm not sure. I guess you don't get the benefit if the weather gets colder, which I think could happen. Right now, it just feels that everyone thinks that, oh, the weather's so warm, it's crazy. But it was just 2 weeks ago that the weather was super cold and we were going the other way. I don't know, Patrick. It just feels. I feel. To buy. I got my food tickets ready.
Yeah, I feel that you're going to be right on in terms of the fact that the lows will be somewhere down here. I'm just not. I just don't think that if someone is looking for the beginning of the next bull phase of nat gas, I think you're going to be waiting, because a transition from bearish to bullish doesn't happen in V bottoms. Sometimes.
Well, I disagree with you there, because if you look in June, July, it did. Well, I guess this is all mixed up because it is the front month. So it is difficult, but it's extraordinarily volatile. Let's just agree on that. And this thing could change in a heartbeat. Yeah. And it feels bombed out. Anyways, what else you got?
I wanted to talk copper. Like, look at this breakout in copper.
So you'd be proud of me. I actually I highlighted it and talked about this breakout, and I was like, and I joked and said it's for sure not going to work, because I bought the breakout. It just goes to show you that every now and then I actually get one right. I love it, Patrick. I think copper is great. I think it's a terrific looking chart, and I don't know. I think people are overthinking it.
Well, I was all of the third quarter of last year going into this year was talking with members about a 4 1/4 on the upside. Now that it's trading there, I feel like I'm in the exact same scenario as what I made that call on gold on our last week's episode, where I'm like, yeah, but can it sustain above there? But then gold went ripping through 1900.
How about you give us, all of us copper bulls, a little piece of something to hope for, and tell us.
I say 4 1/4 bumps its head on 4 1/4.
Nice.
I'm not going to say anything bearish. It just bumps its head there.
Okay.
All right. Last thing, and we'll leave it at that after this. I just wanted to touch on that uranium chart. Obviously, a solid breakout last week or the week before, and this week it's been consolidating. And consolidations don't bother me. What I love to watch and see is whether the bulls generally defend the price action at the higher level. I think the most disappointing thing that could happen to uranium would be if it did what the reciprocal of, or the opposite of what we saw in oil, which is it wipes out the breakout out and gets like right back to 15 on the Sprott physical on the downside, that would be indicating a false breakout. But if uranium here holds the 16 level, obviously you can take a short-term trip below 16, but generally, long as it holds in here, that could be the springboard for a push back to the October high and maybe the beginning of a little bull run here. You got your allotment of uranium?
Well, I'm not long as much as I should be, but I will say this: that the Sprott uranium trades at a discount to NAV, and that discount ends up being a function of the attitude or the liquidity amongst hedge funds that are trading this and other speculators. And one of the things that I just like to do is that when it goes to kind of a 10% discount, I like to buy, and when it goes to even, meaning it comes up against NAV, bumps up against NAV, I like to sell it.
Yeah, but that's just
no. But listen, I just want to say,
being an arb guy.
No, but when you're looking at this, you're saying if it goes down to 15, that's going to be kind of worrisome.
It just
to me, if it goes down to 15, but the spot stays the same, and it's just a function of the stock market gets weak, and those guys end up
I get you.
it. And that's my point. Is if you're trading this, get to know the premium or discount to NAV. And watch it closely. It actually matters. And when it's 10 and the market seems like crap, like a 10% discount, you can start picking away. And when it's even, if you are a trader, lighten up.
All right. Anyway, I think that's enough. We got a couple more episodes of things to do here, so I think that's enough for talking charts. Let's move on.
Okay, so now it's time for our new segment. New segment? Okay.
New segment?
So we're going to do it. I actually picked some ones that are right up your alley. Guaranteed to evoke a response.
Get me triggered.
So here we go. We'll go with the first one. 90210 Kush himself, Jeff Gunlunk.
Next page is copper gold ratio, our old friend. Gives us a starting point on where the 10-year treasury maybe should be. This is using a 5-year or 6-year time window for analysis, and the red line is the 10-year yield, and the blue line is copper gold. You'll notice that the copper gold ratio was screaming that the 10-year treasury was going to go higher back into the middle of 2020 and into the beginning of 2021, and now it's screaming that the 10-year should go lower. Never ignore the copper gold ratio. You can explain it away from time to time, but they end up, it's like the dog tied to the stagecoach that's going across the going across the West in the old days. You're going to end up, sometimes the dog can be ahead of the stagecoach, sometimes the dog can be behind the stagecoach, but at the end of the trip, dog's going to be where the stagecoach is.
Okay, so my first question, there's more to it. How old is Jeffrey Gunlock that he's talking about the dog and the stagecoach?
I have no. I think that's like
okay, Jeff, I get it. You needed an analogy. Okay, so now after just telling you that I don't think you can, that gold is giving weird signals. I think that this indicator was broken last year, and is going to continue to stay broken. And I was just wondering what you thought.
Well, you know what, I don't have anything smart to say about it. Because it's not one thing that I track. I kind of look at each of those individual components, but I don't tend to lean on my analysis based on that.
In the past,
I know. Listen, I get it. Like these, it's
the copper going up relative to gold indicated the economy was stronger, and then therefore bond yields would rise. Okay, let's just go on, though, because, copper gold is giving a signal, and I'll just wait till you hear what good old Jeff says about it. Here we go. Anytime now, Jeff.
And this is saying that the 10-year, using the 6-year time window, should be more like at 2.5, rather than around 3.5. And if we use a 10-year time window, which I did not include in the exhibits, it suggests the 10-year treasury, wait for it,
Okay, Patrick, how long do you think he wants to take the 10-year treasury?
Don't tell me negative. Don't tell me negative.
Yeah, no, it's not that
should be
low.
at 2%. So there's tremendous potential gain in treasury bonds at the long end, which is wonderful because
that's it.
Well, he's talking his own book, right?
Well, he's talking your book too. Okay, so the
Why?
next-
I'm not
Well, I
super
think
bullish bonds.
well, yeah, I guess you've shed that skin, although it is still in your DNA. Okay,
Well,
so
I see opportunity in catching it. I think that if we do go into an economic recession and see experience, disinflationary pressures on asset prices, that we could have a bond rally and it be counter move to what we've seen. But I don't know if I want to call it 2.5% yield.
okay, now this next segment is from John Williams. And one of the things that John Williams is the New York Fed president, governor, I don't know what they are. And this is with Nick Tamaros. It's an interview from the summer. And the reason that I think this is important is because a lot of people will listen to Bullard or whoever on the Fed, and they'll think that that's like how policy is getting set. And really, the policy is set by three individuals on the Fed. It's Powell, Brainerd, and Williams. And yes, the others are influencing it, but those are the three that matter. So when Williams talks, it means a lot more than when Bullard is going and speaking. And that's one of the things that you need to keep in the back of your mind when you're discounting the various Fed discussions. What I thought was interesting about this was that this idea that the Fed was looking at inflation of like 7% right now because of the year-on-year effects. Whereas in terms of you looked at it on a month-over-month basis, you'll realize it's running much lower. It doesn't make any sense, and yet people are like, oh no, the Fed's got to keep hiking because, year-over-year inflation is 7%. Well, that's not really how they think about it. And this interview lays it out very clearly. And Patrick, do you have the chart I included and sent to you? Can you you pull it up here for people to watch, for those that are tuning in at home while he's speaking?
In our economic analysis kinds of tends to support this is basically where's the federal funds rate less the inflation rates they expected over the next year. So to me, a real interest rate has to be forward looking in that way. So if you look at market participants, I mean, that's how I think they think about holding a bond. What is going to happen to inflation over the time period that I hold that bond, for example, or have a loan. So to me, it's basically the Fed funds rate less, say, the inflation expected over the next year.
Okay, so what he's saying there is that looking backwards at inflation doesn't mean as much in terms of the Fed policy rate. And so what I've done here on this chart is I've actually shown a one-year inflation swap, which is the market's expectation of inflation over the next year versus the 1 year, 12-month T-bill rate. And that's in essence a function of Federal Reserve policy rates, okay? And for a while there, inflation was, let's just say at the beginning of 2022, when there was lots of need for the Federal Reserve to get out ahead and crank rates, inflation was running 6%, and yet 1 year T-bills were 2%. And that rate was almost at one point a spread of 400 basis points. Well, that 400 basis points has gone from positive to minus 250 basis points, meaning that the 1 year inflation rate is 2.05, yet we have a 1 year T-bill rate at 4.66. So one of the things I just want to stress to people is that the Fed is tight. The Federal Reserve has taken that they've done the catch up that was needed to get the policy from a point that was excessively easy to a point where it's actually tight and can actually slow down the economy. Now, the next part about it is that Paul Podolsky talked about this as well, is we've gone from a point where the Federal Reserve is going to have to move rates aggressively to narrow that discount. But once that discount has been narrowed, we're going to actually have a situation where it's going to be a function of how long they stay at this tight, aggressive policy will mean more. And so he talks about it a little bit here. So let's play this tape and we'll go with this.
Okay. So people ask about the Fed's reaction function, which really means how the Fed reacts to different incoming data. And this year, the focus has been on the speed of rate increases. You're talking about sort of a time dimension, getting to a place and then holding there. The market has been pricing in rate cuts. Are you saying that you don't think that's a realistic scenario at this point? Rate cuts specifically happening next year.
Well, I
forget
think
this was
currently
taped in
they price
August.
in about one rate cut next year right now. So, and that's going to depend on where things are. But honestly, from my perspective right now, I see us needing to kind of hold this, a policy stance of pushing inflation down, bringing demand and supply into alignment. Is going to take longer than, we'll continue through next year. So that's my view right now. And I think it's, based on what I'm seeing in inflation data, where I'm seeing in the economy, it's going to take some time before I would expect to see any adjustments of rates downward.
So, Patrick, one of the things I wanted to stress is that even if we get some bad inflation numbers, I don't think we're going to see a situation where the Fed goes back to aggressively hiking at 50s. And I think that that's something people need to realize, is that the policy adjustment has already been made. We've gone from being extraordinarily easy to actually fairly tight. And one of the things I suggest for everyone to do is to follow the 1-year swap and compare it to the policy rate, and realize that that is, in essence, what the more senior kind of Fed officials are looking at when they're determining whether they're tight or they're loose. And when they were loose, they had to get it caught up. And now it's going to be a function of just keeping it. They've gone it to a tight phase, and it's going to be a question of how long they keep it there.
Are you in that camp with what seems to be the case now, that it's going to be a 25 basis point move here?
Oh, I do believe it's 25. I've been saying this for a while. I think that we're back.
Yeah,
we're going to continue. And maybe where I differ is that I think that there's a better chance that the economy surprises and we continue to have to do 25s for longer than people expect. But I am definitely not in the camp that says that we're going to see 50s again. I don't think that's happening. I really think we're back to a Federal Reserve that will do 25s at a time, and it will be kind of it'll probably be on and off. There'll be a 25 now, and then there might be a pause, and then another 25, and maybe a pause.
I'm in the camp that at any time that they may just simply pause.
Yeah, so I'm not disagreeing that they're going to pause, but I think that if we were, I guess where I push back on people is that they seem to think that if we got another bad inflation print, that there would be a 50 back on the table, and I guess it could happen, but I would be very, very surprised if we had another 50 this cycle. And that's what I'm saying. Okay, so that's it for the serious stuff. Now we're going to do the fun one.
Oh,
okay.
There's one more.
One more. This would be fun. Okay, and it's going to be long, and we're going to talk over it, and I'm not going to. We'll get it. But I was thinking back to the flash crash, and one of the things about the flash crash, Patrick, is that there was still a pit in those days. Like there was an actual.
Are we talking? The
May 6th,
the 2010.
Yeah, May 6, 2010.
Okay.
Okay, and just to set the scene, stock market was at 1164 the night before, so 1164. So roughly a quarter of what of the price that we're at now. Okay. Now this is going to be what they call a squawk, which is in essence someone down in the pit describing the action, what the trades are, and I will pause it to explain different things. But when we start this, it's trading at around 1109. So when you hear them say it's 8 bid at 9, that means it's 1108 at 1109. Now, the market was already fast, so they were no longer trading with 25 or 50 cents, things they were just trading with dollars. So at this point, when we started, it was roughly down 5%. And let's just play it because it's just so much fun, and I think you're going to get a real kick out of it. Have you ever heard this?
All right. No.
Oh, really? Okay, you're going to like it.
All started out up above around 38 even here now, guys, talking about 25 handles of solid sell-side activity here, guys. They have just P's. The limit down in the S&Ps would be 1053 even. So we still have a solid 60 handles of range left. Here they come to sell them again. 9 half trade, 9, 20 straight, 9 even straight here now, guys. 8 half trading as well. Once again, guys, they're going to get it in 8 half trade, 8 even offer. 7 even offer. 6 halves are trading here now. 6 evens are trading. 5 evens are trading here now once again. 5 evens do trade here. You're going to get a new 5 even offer comes in. 4 evens are trading here now. 3 evens are trading here now. 3 even bid here now. You're going to get a low print of
So we're still trading 1103 at this point.
Guys, 2 half offer. 2 evens are trading here now. Once again, I'm offering at 3 even here now. 2 half, but I'm out of at 3 half. 3 evens per here, guys.
So it's 1103.
The figure prints are trading.
So 1100 trades.
Are trading here now once again. We got figure trade here now once again. We are trading 1100 even. Guys, we are 64 handles lower on the day here now, guys. 9 halves trade. 9 even offer comes in here now, guys.
So that's 1099.
9 evens are trading here now, guys. Offered at a figure here, guys. Once again, 9 evens are 1053. Once again, 8 evens trade, 98 even bid an O even here, guys. Once again, 8 even bid an O even. That's a 90.
So we're down 6%. We're down 5.5% at this point.
Here now, 97 halves are trading here now.
Okay.
Once again,
So it's offered at 1097.5 now.
96 halves trade, 96 evens trade, 94 evens are trading, 94 evens are trading here now, guys. Once again, 4 half offer, 4 even offer, 3 halves do trade. 93 evens are trading, 92 evens are trading here now, guys. 91 evens are trading, 89s are trading, 88 halves are trading, 87 evens are trading, 86 evens are trading, 85 evens are trading here now, guys, all the way down. 80.
One second, I gotta pause it. So at this point, it's he's saying that 1085s are trading. Okay, that is down roughly 7%. And just to give context, I figured it out on today's number. That'd be like the S&P down 290 points. Okay, that's right. How many it would be. Like that. These are some big figures, and it's going fast. So here, let's keep going.
4 evens are trading here now, guys. 82 evens are trading. Paper comes in a big seller. 81 evens are.
Okay, when he says paper comes in, that means that that's paper from outside the pit, meaning that's like a big order from a client that comes in. They call it paper.
Here now, guys, 79s are trading. You got 79s trading here now. Once again, 78s are trading. 6s are trading. 76 evens are trading here now, guys. 75 evens are trading. 4 evens. 3 evens are trading here. 2 evens are trading. 72 evens just traded. Once again, guys, we're
down 8% now.
Bid here now, guys. 72 even offer. 68 evens are trading. Guys, 70 even bid here now. Once again, 70 evens trade. 71 even bid here now. With the 72 evens are trading. Guys, 70 over here. Offer that 70 even offer here now, guys. Once again, 70 even offer. 65 even offer here now, guys, once again. Offer that 72.
So it's
offer that 70, 60 even bid at 70 even offer here now, guys. 60 even bid at 70 even
$10
offer now,
wide.
Guys. 60 even bid. Guys, 60 even bid here now, guys. This is the widest we have seen this in years. 60 even bid. I got 64 evens trading. 64 evens are trading.
So that's down 9% roughly.
70 evens are trading. 70 evens are trading here now, guys. Once again, we made it within handles of a limit offer here, guys. 75 evens are trading. 70 even bid at 75 even offer here right now, guys. 70 even bid. Here comes Morgan Stanley to sell. Morgan Stanley comes in and sells 100 cars here. 75 evens are trading.
100 cars it's that old lingo. I think it has to do with that was a car of grain or a car of livestock. I'm not sure, but it's what they call futures contracts in on the floor.
Guys, once again, 75 even offer here now, guys. 70 even offer. 69's trade.
Watch how quickly it goes back up, Patrick, when it comes.
70 even bid here now, guys. 70 even bid at 80. 70. Stop it. It's got to hit a limit. 73 even bid here now, guys. 73 even bid. 70 even bid here now, and that's 72.
So it's kind of gone quiet.
75. 72 even offer coming in.
And they're still trading around 70.
72 even offer coming in here now. 72's trade. 75 even offer is the best I have here for you right now, guys. Once again, at 75. Guys, this is probably the craziest I've seen it down here ever. Guys, that move through the figure was absolutely nuts.
He means through
77
1100.
even bid here now, guys. 77 even bid. At 80 even offer. 78 even offer here now, guys. 78
Here comes the
even
rally.
offer. 80 even straight here. 80 even bid. 81 even bid. 84 even bid. 85 even bid. 87 even bid. No offers in the pit here. 91 even bid. No offers in the pit. 92 even. They just traded the figure. Once again, they're trying to get a figure print in here. 12 handles above the last print.
So that's 4% it just rallied.
Here now, guys, about 95.
Or
Here now,
3.5 or something.
94 even bid. Guys, 98 even's just traded there, guys. Once again, they're going to try and get the print in all the way up to 98 even there, guys. 91 even bid. 91 even bid out about 95 even off here now. Once again, 91 even bid here. Call Allen. 91 even bid.
Okay, that's it. So he has this thing at the end.
Yeah.
Call Allen. Who's Allen is what I want to know. Does he mean Greenspan? Like he's like, call Allen.
Probably.
Let him know.
But I have the chart up here of that move. That was like a close to a 10% move from a top high to low, right? And like you were describing, like I remember actually watching, because that was back in my days when I was doing far more day trading and looking at the SPOOs on a regular basis. I remember being frozen just staring at the screen. Because I didn't understand what was happening. Like I was like, is my machine broken? Like,
it was crazy.
I was like, it was insane, right? But you're absolutely right. Like it recovered. I mean, it hit that low of around 1,056 or whatever it was, and it rallied within a short time. Like what is that on a percentage basis?
It
off
went
that
from
low,
1060
it literally
to back to 1100.
like a 6%.
So, yeah, it was.
Yeah, it was
4%,
basically a 6%. Well, from the low print to the close, it was 6%.
Yeah. It's pretty fun. Though,
and that literally happened in less than a half an hour.
Yeah.
Right?
Well, not even. It was the real meat of it was in the 5 minutes we just listened to. I just love the Chicago raspy voice. They all like the real. Real,
that sounded like it was like an auction thing or some.
And their voices, because they're so. When you meet like a real floor trader that was down on the floor, that was
nonstop yelling.
Not one of the ones that was trading for their own account, but one of the ones that was like a broker that had to do a lot of screaming. You'll hear it, and they got that thing, and it sounds like it's really. And I don't know what it's called, but it's really tough on their vocals because they've been screaming so long. So they're actually really quiet when you hear them, because they kind of they either have like. They rasp or they rasp or they scream like full on. Anyways, and that fellow had it, and anyways, good fun. I just thought that was be a lot of fun, and it was good.
That was great. That was great. Thanks for sharing.
All right, time for
skin in the game. Now we settled that you won the bet last week, but since we did our annual bet last week for that steak dinner, we just simply actually this week have to make the new bet. So you're making the bet, and it's about we settle it at the end of the month in 2 weeks.
Okay, so let me just tell people about Skin in the Game. It's our weekly opportunity, bi-weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every second week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and we have a match up to 50 points. The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for a dinner where they can grill him about why he has so many bad calls. All right.
Nice.
So I am going to pick one, and I think we got to go there.
No.
Yep.
No.
Copper.
Oh, okay.
What were you thinking?
All right. No, I was playing with you. So we got copper, 421.
Yeah. So I've been kind of wimping out with all these making you buy options that are overpriced, and that's getting kind of boring. So let's do something fun. So this is 2 weeks from now, right?
Yes.
And 2 weeks is a long time. Anything can happen. I will say, I feel like it is in a bull market, so I should have. Well, let's just do straight up or down from here.
Damn it. Fuck. because I am bullish copper. But no, I'll take the down. I'll take
All
the
right. Okay, what do you want to do? What's the score, by the way? Have we got a score recently?
down. It's 22-29. So you've got a 7-point lead. I had that period where I tied it with you. But
you kept buying overpriced vol for me.
Yeah, I kept buying those little lottery tickets you kept offering me. And so, you know what? I'm going to just do 3 points.
Okay, 3 points it is.
Right? Like I can't let you go and way too ahead. I need to chip away here with something I can palatably accept. All right. 3 points?
3 points it is.
Okay. So, Lena, the level's 420, 4 spot 216 on copper. All right. Well, there it is. We'll see in a couple of weeks what it is. But this is where we get Lena on here to save the podcast from people
no
being
stupid
too
questions.
bored of us. No, yeah.
Just stupid answers.
Lena, save us.
Okay, first one here. Market Huddle team, thanks for putting together a great show. It really helps to break up 2 weeks filled with stuffy financial podcasts where the hosts and guests take themselves way too seriously.
Well, we certainly don't have that problem here.
First off, I'm a fellow crayon chewer.
Oh, God.
Nice. I like this guy.
I've learned the hard way that, like most people, I suck at discretionary trading. Thus have spent considerable time over the past 3 years building a systematic approach to investing using live trading and backtesting.
That feels to me not like a crayon chewer, though. That feels more like a quant, which I respect and I like. That's not a true crayon chewer. He's chewing microchips.
Fair enough.
There's a lot of scrutiny around the effectiveness of backtesting given the risks of overfitting and relying on historical behavior to project future results. I completely agree, especially when a backtest only considers the most recent decade or less. My question is, with regards to challenging the stigma of backtesting, putting aside the consideration of overfitting, do you think that it is reasonable to have confidence in a strategy when the results have backtested over decades? What do you think would constitute a safe time frame, 20, 30, 40 years? I feel that including a time frame that covers 3 or 4 major recessions would be sufficient to draw statistical confidence. But I'm still getting outstanding results, 30%. What is this?
CAGR.
CAGR?
It's oh geez, I know it. It's basically annualized returns. Compound annual. I'm not sure what it's basically annualized returns.
All right. So I'm concerned that I'm missing something. I really appreciate your feedback, whether on or off the air. Happy holidays.
Can I do this one, Patrick?
You can. I have something I want to contribute, but go for it.
Okay. So I think these are great questions. First of all, one of the ways that you can check on the overfitting is to do out-of-sample testing. So just, do your back testing on a certain sample and then pull out a sample and check it on that. You can avoid that. But I kind of push back on this idea that you need, let's just say 5, 10, 20, whatever your amount of years is for a system to be statistically significant, because I feel that markets change. And I feel that, yes, I understand the argument that if something works over that longer period, it will likely continue working over a longer period. But at the same time, I think that there's periods where specific strategies work really well and then they don't work so well. One of my theories is that when you look at like a Renaissance or all these different other kind of quant shops, is that they tune strategies up and down depending on how effective they've been or their performance. Mm-hmm. They almost do a trend following on their strategy, if you understand. And I really I don't buy the argument that because something's only worked for a year or whatever means that it's not a good strategy. But the one thing I will say is you need to be prepared for it to not work, because I do think that there's periods where there's anomalies that consistently make money. And as long as you're quick to give up once that anomaly goes away or whenever that gets done, I think that there's nothing wrong with having a kind of a bunch of different types of strategies that don't have back testing for 10 or plus years.
Right. So what I want to ask you, and I sort of think about this from a bigger perspective. Take a little bit of history. I mean, currencies fail, governments change, geopolitics change, the world reshapes, wars happen. When you're talking 30, 40 years, a lot of things can change. And when you look at securities, and they're basically priced on a nominal basis based upon the price history. And the thing is that suggesting that if you backtest something 30, 40 years, that it means that the next decade or decade after, the system will be able to replicate that. There's so many variables that can be introduced and that could change things. Like I feel like you don't want to overanalyze. I honestly feel that that's overkill going that far back. I don't know.
Well, I think the other thing is there are some tried and true elements of human behavior that do work over that long period. And I would say that, the trend followers.
That's why something like
that's why would argue that you can go back that far, and it does work over that long a period. But there's
Right.
years where it doesn't work, or it's so it's difficult. Anyway, great question, lots to answer there. Hopefully, we've given you something to think about.
All right, next one, Lena.
Dear Kevin, the optimistic, and Patrick, the perma-bear. Having listened to your extended No Stupid Questions segment, I had a follow-up question. Both of you do not sound overly optimistic about equities for 2023. I think your quote was that there were many negative catalysts out there that were likely to drag the market lower. I would argue that they are all well known and therefore likely in the price. In my opinion, the landscape is strewn with potential white swans, e.g. a growth or even a deflationary impulse out of reopening China, some positive progression out of Ukraine, a soft landing is achieved in the US. What potential white swans do you see out there that would change your view to being more optimistic on equities?
Patrick, I don't think he's ever seen a white swan. He's mistaken it for a duck each time.
Yeah.
No, that's not a white swan. That's a duck. I think this is a great point. This listener has a great,
I just don't think it's been all priced in. But I mean, but that's not the question. The question is, what are the white swans? So I'm not going to go and defend the risks, because we already talked about that last week. But realistically, do you have any white swans? Like, what is it that you would see that could change things to being more outright bullish?
A soft landing. A soft landing, but the trouble about it is that one of the things that I'm worried about is that even if we get a soft landing, the Fed panics and hikes too aggressively. So that's one of my concerns, is that the economy ends up being stronger than expected, yet then Powell goes back to hiking more aggressively. Even though I don't believe that is the base case of what he would do, I really do think that the attitudes change. But I also think that the market would assume that he's doing that. So there would be kind of elements and periods where it'd be like, do we really want a stronger economy? Because it'll mean higher rates. But listen, Paul Podolsky, he was just on our show. He's talking about very much in line with what this listener is, highlighting, is that a lot of these things are in. He thinks that the market has overdone all the negatives, and that on the whole, stocks go up and we're going to go back. And you know what? I think it could happen. I though the one thing I will say is that I think that the risk reward isn't as high as it is at other times. And I don't think we're going to get a situation where it's going to be that you're going to achieve that much better of a return in stocks than you will in like corporate, investment grade paper. And that's probably what I would say, that there's better trades out there.
So let me put my white swan is more specific, which I would say is that while I don't see a white swan for all the tide to rise and all equities broadly rally, and S&P's clearing 5,000 on the upside on the thing. But I think there's plenty of room for there to be bull markets within this market condition. Things like commodities can be in a bull market. There could be a bull market in bonds? No, I'm just not going to say. But there could be different places where you can actually make money. Like we were talking about those charts in equities, in the international equities and some of the different stock markets around the world, maybe emerging markets. There could be bull markets that are uniquely positioned based upon the way these macro conditions are. So even though, let's say, I am not so optimistic about the S&P, it doesn't mean that there isn't places to invest.
Yeah, I'm just pulling it up here. Like we have forward S&P is roughly 17 right now. Let me get this right. I'll do a blended forward 12 months. Yeah, so we're 17. We're down from 21. And I guess you could make the case that if earnings just stabilize here and then it ends up being the deflation and it kicks in and we get below 2%, and it looks like the Fed will, instead of raising rates, could actually maybe be lowering rates because there's so little inflation, and you go back to 19 or 20 multiple, you could get stocks up. I don't. I think it's just the risk reward is what I go back to. I'm not sure that it's going to be the upside is pretty equal to the downside, and then with the other different things that you can invest in, I think there's better things to do. But anyways, that's what makes market.
Yeah.
The fact that Patrick and I are both negative means the thing's going to scream higher. It's going to be all-time new highs, just like the FTSE. Okay, next one, Lena.
Greetings, Lena. Can I submit a question, please? Yes, you may. Thanks for the show's team. It's great, and I look forward to yours more than that one with the old and young dude just raving on with each other. Yeah, the one with the crappy soundtrack of the band that plays terrible covers.
Okay, go on. We don't know.
No comment.
My question is that when you were trading on a professional desk, what were your annualized expected returns? Just trying to see how my investment performance stacks up against professionals. Thanks for Lena doing all the heavy lifting and making these guys sound good.
Yeah, she does do all the heavy lifting. Unfortunately, we still don't sound that good though. So on a sell side desk, it is varied. And it depends on how much capital you're using. Some people, like, there would be, 100% would be what they'd expect some prop traders to be. Other prop traders that were trading with much larger size, they might only have 20 or 30%. And it goes back to what we answered the question last week about the volatility and the drawdowns. But I would say, it was more. Those were different times, and it was there was lots of advantages to being on a prop desk, and especially if you're a primary dealer. You guys won't get that joke because you don't listen to him, but he'll get it. And I would say that there was lots of prop desks that were making 100+% returns, but once they started to do it on real size, the numbers were much different. And it's just, anytime anyone's asks you for numbers, I think you should just always be wary of they give you the numbers. It kind of, don't play the game.
It's much more fluid.
But not only that, don't play the game based upon what someone else is earning. Like I know guys that had 100% years last year, and yet someone else had a 200% year, and they're like, oh damn, I really sucked. And I'm like, no, you know what? Don't compare yourself to anyone else. You make yourself better at this thing. Keep working on it. Make sure you don't, that you're always in the game, and don't worry about what anyone else is making. That would be my real advice.
Yeah.
Okay.
Next question. Next question.
Hey, gang. I don't want to goocher my trade, so I won't name names, but I am long one company and short another company and open the position at the same nominal value. I just think the long will outperform the short, and the companies are in the same industry, but vastly different market caps. Are there best practices for managing this position? Should I be closing and reopening this position every day? Should I size each side based on the market cap? Should I have a stop loss on the short since that is the riskier side of the trade? How risky is it to hold through an ER? Thanks for answering this novice's very stupid question.
What's an ER? Earning recession? Or like, is that when you go to the hospital? I got a real bad trade, dog.
Yeah, the one comment I would say is like when he says size it by market cap. Well, obviously, okay, let's say you take a stock that's a $2 small cap, and you're doing a long short against a mid to large cap that's a $50 or $100 stock that's far more widely owned. That market cap is not what you're sizing it by. You're sizing it based upon the volatility. The thing is that $2 stock can easily swing to $3 and make a 50% advance, while the larger cap stock is not going to as easily make the same percentage move. And so that's more about sizing volatility rather than market cap. Would you do it the same way? Like it's...
Yeah. I'm thinking, though, that this one might be a $36.50 stock or a $12.72 stock against a $122.40 stock. And that $122.40 stock is at vastly larger multiple than the other ones. Like, so let's say you have a new company in an area, in an industry, and it's the one that you're short is trading more volatile. It makes it really a lot more difficult. And it is kind of one of these big questions. Do you go on market cap? Do you make them equal weight? Do you make them, do you base them on some fundamental value? What do you do if it goes against you? Like, there's so many great parts of this question, and he's looking for an answer. And the reality is that we're not going to have an answer, because this is a little bit of the secret sauce that's into trading. And ultimately, these things are going to depend on what he thinks and how he's going to be able to withstand volatility as it moves against him. One of the things I will say, though, is by its very nature, shorting is more difficult. And if you own a stock and it goes from 10 to 100, everything is great. You know, it keeps getting bigger and bigger and bigger. If you own a stock and it goes from as a percentage of your market cap of your book, it's fine. It becomes a bigger amount. But the trouble is that when you're short, it could potentially go to infinite, and you end up having to actually go and cover it as it goes up against you. So trading something on the short side is a different skill set. And like when you listen to like Mark Cohodes and all the other like dedicated short sellers or Chanos, you realize that managing that short is probably every bit as important, and in fact probably even more important than actually choosing the short. And that is the part. So there's no easy answer to your question. But it is something you should continue to study, and ultimately you should make your own plan, and you should always have a kind of a, if this happens, I will do this. Try to imagine things going against you and have a plan, so when they come there, you won't be like, holy shit, I didn't expect this. I don't know what to do. So that would be my advice. Yeah. Imagine things going against you and ask yourself, how do I want to deal with it if this happens? How do I want to deal with it if that happens?
Yeah. Yeah.
You have anything to add?
Nope. Lena, where can people submit their questions?
If you have any questions for Kevin or Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. Thanks for tuning in to the Market Huddle. We appreciate you spending some time with us. Please give us a follow on the Twitter at the Market Huddle. We're there every day. Lena gets tired of talking to Patrick and myself. You can listen to Market Huddle on all the networks, and please rate and review us. Patrick, where can they find you?
Yeah, you can find me on Twitter at Patrick Ceresna, or you can follow me at bigpicturetrading.com. Kev, where can they follow
They
you,
can
buddy?
go check me out at themacrotourist.com, and you can come by and visit me in my Substack chat. We have lots of people in there sharing all sorts of things. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show. All right, Patrick, time.
All right, we got to rate the beer. But before I give my score, I expect for next episode you to find out which of your kids drank it and allow them to score 1 out of 10 what they thought of the beer.
I will.
All right,
do that.
I want to score. I want to know what they thought of the beer. You know what? As an IPA, it actually I quite enjoyed drinking it. It was actually more down the center of an IPA. It didn't stand out for me with anything spectacular other than it was a really great beer. It tasted great. If you're looking for an IPA down the center, it's great. I'm going to give it a 7.9.
Right down the center score.
Down the center, because there's all sorts of different crazy IPAs. This is going to be. I'm just saying, this is a very traditional, 6%. Good tasting IPA. I liked it. It's a good one, and I recommend anyone try it out.
Before I forget, I have a big faux pas that I did in terms of someone was kind enough to send me some socks. And I don't know, I tweeted it out at the time, but then I forgot to mention it on the show. So you know me, I'm a big fan of Le Bat 50. It's me and my boy and my 50. And our good friend Eric from La Belle Provence, he tracked me down and he sent me some Labatt's 50 socks, and they are awesome.
Wicked.
They are awesome. I wear them with pride. They are green and they do stick out, but they are awesome.
But that's in now. Justin Trudeau even wears colored socks.
Well, he started it actually. Yeah,
Yeah.
no, he did. So, anyways, I do want a big thank you to Eric. He sent a very kind note, and just want to say that the feeling is mutual. We appreciate all of the folks that tune in, and it meant a lot. And I apologize that I'm late saying thank you. I said it on Twitter, and I realized it was. I'm going to blame Patrick because it was supposed to be the December 30th, and then you were in busy whatever country you were in, and that didn't have internet, and then I forgot to do it last week. So, anyways, Eric, thank you very much. La Belle Provence, I hope to take you up and to drink a 50 with you in person someday. Just thank you very much. All right. Should we? Sorry, did you have something to say?
No.
Well, then why don't we call it an early night here? Let Lena get to work on cutting this up, and we'll see everyone in 2 weeks.
All right. Have a great day, everyone.
Thanks.
Cheers.
Take care, everyone. Bye-bye.